And they appreciate your candor and your Okay, we're going to reconvene the hearing. Since we went over, we have a lot of ground to cover, so I assume members will be back soon. If there are any members within the sound of my voice, please come down so we can have the benefit of your input. Fine, you don't do. There's this, but. All right, the next witness. Okay, on the next witness on the agenda are two commissioners. I'll invite them up one at a time. And the first is Commissioner Jennifer Ito. First and foremost, I want to extend to you California's gratitude for the time that you have put into this effort. That there are people who are willing to take on this burden when asked by their government to help, and to do it with such commitment as the commissioners did, including you too. I think is commended, and it is the ultimate accomplishment in a democracy. So I want to thank you for the hard work and the many hours that you have put into this. And with that, I'd like to invite Ms. Ito. I think she's next on the agenda. Yes. Up to testify. You can sit at the table facing us in the middle. Yeah. I'm going to read, as you're settling in, I'm going to read the bio because I'm just very impressed by the background of the commissioners and their background and expertise and judgment that they bring to the commission is borne out by their accomplishments in life up to date. Ms. Ito has served as the Research, Training, and Policy Education Director of SCOPE, a community-based organization dedicated to reducing and eliminating structural barriers to social and economic opportunities for poor and working-class communities. Prior to joining SCOPE, she worked on urban environmental issues in Los Angeles and on rural sustainable economic development in Central America. Ms. Ito serves on the board of the Economic Roundtable. She earned a Master's of Arts degree in urban planning from the University of California, Los Angeles, and a Bachelor's of Science in Mathematics from Occidental College. Welcome, Ms. Ito.
Thank you. And Mr. Chairman, members of the committee, I just want to thank you for this opportunity to appear before you to discuss the recommendations proposed by the Commission on the 21st Century Economy. Just as a side note, as I was preparing this testimony, I realized that this is really the first time for an opportunity for me to put out there kind of who I am, the perspective that I bring, and where I stand in terms of the set of recommendations. It is, for me, thank you for the recognition for the work we put into it. For me, it was really an honor to serve on this commission.
I'm sorry, Ms.
Ito? Sure.
You said this is the first time that you've had the opportunity to offer your recommendations?
Well, to bring to, I mean, in the final couple of public hearings, there was never an opportunity to express how we felt or where we stood in our positions around the core package. There was lots of opportunity for questioning, for clarifying some of the assumptions and the analysis put into it, but at no point was there, as a full commission, in open testimony and opportunity for us to gauge, to state as a commissioner where we personally stood.
Was there a vote at a convened meeting on this proposal?
Not on the core package. In the final hearing on some of the other recommendations in Section 3, there were recommendations that were put forth that were not by consensus, but that were supported by, I believe, 3. The minimum was that we have to gain support by 3 commissioners, 1 governor's appointee and 1 legislative appointee. That was the only time that we actually went around and expressed where we stood in terms of our recommendation for putting these forward in the final report.
But not at any formal meeting?
That was the final. That was
That
at the
was
final hearing, right?
So you were able to explain your, well, but there was no vote, right? There was no vote.
Right. That's correct.
But you were then given an opportunity to express your opinion at that time, or?
It was because of the limited time that we had, and because of the complexity of the proposals that are part of this core package. The time was spent on more for questions. At the beginning, Chairman Parsky did say he wanted to reserve the initial part just for questions, clarifying questions, and analysis, and then in the end we would have an open forum to express our opinions, get a sense where folks stood. But because of the lack of time, and we actually ran over several hours in our hearing, we actually never got to that point of the agenda.
Well, we plan to give you the time that you need to express your opinion on this proposal, so please proceed.
Great, thank you very much. But I would like to recognize Chairman Parsky, my fellow commissioners, and the staff for their considerable efforts in tackling such a daunting task within a very short time frame. I believe that everyone held a commitment to work towards consensus, towards the goals set forth by the governor's executive order, while not compromising his or her individual principles. But I do want to just begin my comments just to share my perspectives both as a commissioner and as an advocate for California's underserved communities. Express my concerns on the recommendations put forward in the Commission's final report, and to explain why I did not endorse the report moving forward, and then just to share some thoughts on the principles that I would urge this committee to consider as you move forward. Well, tax reform is important, and important and needed for the entire state of California. For me, it's especially important for underserved, poor, and disenfranchised communities. As you mentioned, I work with a nonprofit organization, Scope. We were founded in 1993 in response to the 1992 uprisings in South Los Angeles. And while we began as a neighborhood membership-based organization focusing on addressing the severe conditions of poverty, unemployment, crime plaguing South Los Angeles, we've since evolved and employ a broad range of strategies to pursue policy changes at both the local, regional, and state level. The strategies that we engage in are primarily around grassroots community organizing, leadership development, civic engagement, policy research, and advocacy. For the past several years, we've worked closely with other membership-based organizations across the state that represent poor and working-class communities, and predominantly African-American, Latino, and Asian Pacific Islander communities under the name of the California Alliance. The issues that our constituencies face range from the lack of access to quality jobs, healthcare, education, substandard housing, inadequate public transit, declining environmental standards, also range to discriminatory land use and zoning decisions. So in recent years, we recognize that in order to make substantive improvements in health, economic, and environmental outcomes throughout the state, that we needed to address the failures of the current tax and fiscal system. And find ways to pursue a pragmatic set of reforms that can put an end to California's perpetual budget crisis. So in other words, and because if not, we get caught in the trap of narrow self-interest that pits one region against another, or one group in one issue another, and often leads to proposals that rob Peter to pay Paul. So residents, workers, and business owners based in communities with high concentrations of unemployment and underemployment have suffered the brunt of unstable revenues stemming from an outdated tax system. So these communities have an objective interest in ending the up and down dramatic upswings in revenue and in spending that have resulted in the massive cuts that we've seen to health and human services, and in the ongoing deferred maintenance of public infrastructure that's increasingly becoming a public health and safety issue. And we also come to the table for the interest in reinvigorating local economies, which are the foundation of healthy and safe communities. When individuals have family-supporting jobs and employers have well-prepared, productive workers, not only do the workers and firms benefit, but the state as a whole due to increased tax collections and a decreased need for social safety net programs. So recognizing this need and the importance for structural tax reform, I was honored to be invited by Speaker Bass to serve on this commission. We had an opportunity to step back from the immediacy and the severity of the state's budget crisis, really set aside cynicism around the possibility for systemic reform, and take the opportunity to move beyond solutions that just tinker at the edges. And given that the composition of the commission was representative of a broad spectrum of economic philosophies, political ideologies, it was also an opportunity to move beyond the traditional political deadlock and come together to discuss innovative approaches to tax reform and to craft concrete proposals that achieve multiple objectives and benefit the broad swath of California's diverse communities. So given the limited resources, time being one of the most valuable, I believe that we made the most of the opportunity we were given, yet fell short of being able to provide a tax reform package that serves the best interests of the state, its residents, workers, and businesses, thus my decision not to sign on to the report. The core set of reforms fails to meet many of the goals set forward by the governor's executive order. It will not address the state's the state's structural budget deficit. In fact, it may exacerbate it. Based on the analysis provided, expert testimony, and public comments, it's my understanding that this core package moving forward will exacerbate the state's structural budget deficits, has the potential of driving businesses and jobs out of the state, a downward pressure on wages, thus putting a further strain on already underfunded social safety net programs. But in short, our plan is a great job creation strategy for tax attorneys. So first, I'd just like to take a couple of minutes.
I want you to go and make your statement.
Okay. So just, I'll take a couple moments to express my concerns around the recommendations. There was a lot of talk around the issue of volatility, and in the end, I don't agree with the approach that the Commission has taken in the final set of recommendations. And this just stems from my own personal belief that the issue of volatility is more of a budget management issue. Thus, I support the further examination of a viable reserve fund. In the Commission, we were not able to dedicate sufficient time to examine what's in your the Commission's final recommendations on the reserve fund. So if you do move forward, I would urge you, I believe that this is worth further investigation. But in the spirit of compromise, the approach that the Commission did take was a two-pronged one. First, smoothing out revenue by significantly reducing the revenue from personal income and eliminating the corporate income tax, and also establishing a new reserve fund. So as was argued during the Commission hearings, if California were really able to set aside revenues during economic boom and draw down on those reserves during economic downturns, I don't think revenue peaks and valleys are a problem. However, with the two-pronged approach, if this were enacted, I think the result is going to be, and the result is indeed an elimination of the extraordinary peaks and valleys. It seems to me that it's going to be a greater challenge to build the reserve without the ultimate effect of being a spending cap. My predominant concern around the proposed package is about the overall shift in the tax burden to low and middle income households, both through the flattening of the personal income tax and during the first 5 years in the phase-in period, the coexistence of two regressive taxes, both the sales and use tax and this new business net receipts tax. Arguments were made that the package preserves progressivity and benefits all income brackets. I don't know if you were able to look at the staff analysis, but if you have, you've seen the numbers about the disproportionate benefits of tax relief accruing to the highest income brackets. Okay, okay, excellent. So I recognize the difficulties and the limits of modeling changes in tax burden by each income bracket, but I think that no matter which way you look at it, the drastic reduction in the progressivity of the PIT through the establishment of the two bracket structure cannot sufficiently be offset by the phasing out of the regressive sales tax.
On that issue, the numbers that we've reviewed, and you tell me if this sounds accurate to you, was that at the lowest end, at the lowest income levels, there would probably be only a $3 or $4 reduction in taxes, and at the highest level, 101,000. There'd be $101,000 in reduction in taxes for those that made were taxed at the highest level.
That's exactly. I believe it was 109,000.
Right.
So I attended, I want to make a couple comments about this new business net receipts tax. I attended one of the workshops and I followed the developments of this closely, and I really appreciated the discussion on examining this new tax as a mechanism for achieving the set objectives of broadening the tax base, improving the state's competitiveness, and providing a stable source of revenue. But in our deliberations, we did not receive any expert testimony or public comments in favor of the business net receipts tax. And although I don't necessarily expect any business to come forward in support of any new business tax, and I also question the extent to which taxes affect firm location expansion decisions, I do expect that businesses will seek ways to reduce their tax liability. So if you do, as the committee, deem the business net receipts tax worthy of further examination and study, I hope that you will measure it against the goals of supporting a vibrant 21st economy, ensuring tax fairness and equity, and ensuring that there's no further harm to the state's residents, workers, businesses, and investors. What I walked away with at the final hour of looking at this business net receipts tax is the potential impact that it will have on incentivizing firms to replace employees with independent contractors and on contracting out employment, either to businesses out of state, out of country, or even within the state. And then on top of that, with the minimum 500,000 threshold in place, I think there's also potential for revenue leakage in the long term. And then the fact that there's no other state or country that has implemented this version of a value-added tax, and that I believe it was in Ohio, the revenues from a similar net receipts tax were underestimated by 20%. I just think that this would have detrimental effects on the state with the size and complexities of California, especially given the current economic climate that we're in. I just don't think that this is the moment for us to experiment with something untested at this scale. I appreciate the work that fellow commissioners and staff put into the thinking through the 5-year phase-in period and to proposing a safety valve that if the business net receipts tax were to underperform, there are certain mechanisms we have in place to ensure that the overall impact is revenue neutral. However, my concern stems more around the potential long-term outcome and the impact that it may have on revenue and on jobs. From the analysis we were presented, the revenues raised by this new tax system are expected to grow more slowly over time than those raised by the state's current tax system. In addition, if this were to have a negative impact on firm behavior, the way that we heard through the public testimony, the erosion of the state's job base will further exacerbate the budget crisis, not only due to the decline in income and the income tax revenues, but also because of the increased demand on public services. If this proposal were to go forward, I also could not endorse it because of the proposal to eliminate the corporate tax within the first year. I just believe that this would be a difficult system and tax to bring back into place should the business net receipts tax be found unfeasible at the end of the 5-year phase-in period. I think I could have considered as a starting point for discussion the simple proposal of replacing the state sales tax with the business net receipts tax. I think further examination could be given to a scenario in which this tax is instituted at a low enough rate so that it does not incentivize changes in firm behavior. However, to use the business net receipts tax to replace lost revenue from a $15 billion cut in personal income tax, a $12 billion cut from the elimination of the corporate tax, and the phase out of the sales tax of about $26 billion, the rate that would be required would be high enough, I believe, to provide incentives for businesses to seek creative ways of reducing their tax liabilities. So at the end of our process, I could not personally stand behind the set of these recommendations and be responsible for sending this package forward in its current form. I believe reform is needed, and there are no quick and easy fixes. The goals put forward by the governor's executive order are good guideposts for evaluating reform proposals. However, as we have learned, they are difficult to achieve and are often in conflict. So I just want to conclude with just a few statements on what I believe are the key principles that I would like you to take into account as you move forward in considering tax reform. First and foremost, the principle of do no harm. Regardless of where you stand in terms of who should pay for public goods and services, I urge you to consider reforms that, at the very least, do no further harm to residents and businesses that are struggling to make ends meet in the current economic and fiscal crisis that California is facing. Secondly, I hope that you will hold in high regard the tradition of the progressivity of our tax structure and support tax fairness and equity. And lastly, but not leastly, also look at reforms that are going to support a vibrant 21st century economy. So just in conclusion, although I don't agree with the core package put forward by the Commission, if our efforts help to spur discussion and debate on structural reforms, I feel like it has been worth our effort. And so just thank you again for this opportunity to appear before you.
Well, Mr. Parsky testified this morning, and we actually went up to 1 o'clock. But his view is that, I mean, they modeled their revenues neutral approach based on a 4%, but he was encouraging the legislature to consider less, but certainly no more than 4. Mm-hmm. And you're saying that 4% won't be enough.
No, I believe that 4%, I agree, and that's where we have a point of, I agree that a 4% could be substantially high enough to incentivize businesses to seek creative ways to reduce their labor costs, either by contracting out or shifting employees from employee status to an independent contractor.
But if I understood you correctly, and certainly correct me if I'm wrong, that a 4% business net receipt tax would not raise, in terms of the business side of this proposal, would not raise sufficient revenue to meet California's current budget.
They will grow more slowly was one of the presentations that we saw earlier in the hearings.
So you're saying it grows more slowly, the business net receipts grows more slowly than what?
Than the current tax system.
So,
and if I can add,
yes.
And I believe that, and this is where I would encourage you to examine further and to question staff about the analysis, but I would wonder what the economic assumptions were, because I believe that that does not take into account the impact that this could have on the economy. Thus, I would expect in the long term that this will have a drastic reduction in revenue in similar ways, perhaps that has happened with the corporate tax.
So in terms of revenue, state revenues, this is a loser, not a winner.
That's correct. That's my understanding.
All right. Can you? I asked Mr. Parsky really what did the vote of this commission, those that voted, I guess, to put out this report, what did it mean? And he's basically, he said generally it means that they think this is something that you should consider. Mm-hmm. But certainly didn't suggest that it was an endorsement by those commissioners. Do you have any insight into how I know the vote wasn't taken in any meeting where everyone was together, but do you know what the process was, and did you have any discussions with any other commissioners?
Right. Well, and I spoke with Chairman Parsky after the last hearing, and I believe that he was trying to find ways to figure out what we could agree around, and this is where his proposal that signing on and endorsing this doesn't mean an endorsement of the recommendations, but for this report to move forward.
Well, even though you did not support this report, what is as a commission member, what is your understanding about what this report means in terms of the work product of the commission and the charge that the commission had to meet?
Well, I mean, to be honest, I was never exactly very sure about where this core package came from, where this proposal for the business net receipts tax came from. I mean, all of the expert testimony that we heard spoke against it. I believe that there was, and for the drastic elimination. I mean, really, all the elements of the reform package, I was unclear from the beginning. I mean, and personally, my interest was in the drastic changes into the personal income tax, and so that is where I have primarily focused.
So are you saying that so you're saying you don't really know how the business net receipt tax came into?
That's correct.
Is it because you just weren't interested, or is it fair to say that you were active participant and would have noticed if someone had testified, made a recommendation, sent in a proposal in writing, and you're saying none of that happened?
Not to my knowledge.
Were you at every meeting?
I was at every meeting. Mm-hmm. Mm-hmm.
All right, Ms. Harking.
Hi, thank you. It's very nice to hear from you. I have not really heard any support for business net receipts, but I haven't heard a full analysis from anybody. I think because of the timing and the way that this has come out, you were under a lot of pressure and to get this out of the gate pretty quickly over the last couple months. What I had asked for were comparisons and contrasts. This is what your tax liability would have been before, and this is what it is now. And I think that to the extent there are a couple examples in here, I actually cranked them out myself, and they were very equal. So I think the business community probably hasn't had time to assess this. There's also problems I do understand with the contract versus for hire employees. That was huge. People are very nervous about that. I think one of the biggest problems, it's because I'm not opposed or supporting this. I've given it a real, open mind, because I see a lot that I like, and I see some things that I don't. So that probably means it's a pretty good proposal overall as far as fairness goes. But I think the biggest problem we are facing is one of the things that you've brought up, and one of the things I believe the Commission is very aware of is the timing of this. There is no cushion in the business community right now to absorb a problem or a hiccup, and I think that's what's frightening most people as well as most businesses. And so to the extent we give this a real thorough vetting and calm things down and actually let people have a chance to look at this and analyze it, I would hate to throw out the entire study, but yet I don't want to see it so interfered with such that we end up with just another one-sided policy in the state that we see frequently coming to the floor, where there's definitely a huge partisan split. So I do appreciate your comments, and I take them very seriously, and I understand where you're coming from as far as not having the time to have all the input. But Mr. Parsky did say that there was an option for the legislature to work somehow with the contract versus for hire part of this, which may have, had you had more time, you might have been able to iron that out. As far as the we went a lot into the Prop 13 and revisions and in the first section with Mr. Parsky. How do you feel on the property tax, either the split roll or the other?
I mean, I firmly support the split roll. I mean, I understand that there are challenges given the nature of our state and where individuals stand on that, but I believe that the split roll is an opportunity for us and addresses a lot of the points that I've highlighted in terms of tax fairness and equity. When we looked at the numbers, it has been the most stable revenue source. Given, nothing's going to be normal under the housing boom and bust, but in comparison to the other revenue sources, that has been one of the most steady.
Okay, so with that in mind, that you would favor a split roll, one of the things I have heard from all businesses just about across the board is, hey, you know, people that, real estate companies from just small entrepreneurs, they're on triple net leases. If you do increase the property tax and the occupants are on triple net leases, does that not hurt the small business person?
I'm not familiar with triple net leases.
Okay, triple net leases mean that you sign a lease and you pay separately for your property tax or any increases and whatnot. So, I mean, that's one of the things, I think, the areas that you might want to examine. The second thing is, one of the mandates or the goals was to decrease volatility. I think one of the surprises that I have read about Prop 13 and the income tax system as a whole is that Prop 13 created a very level and stable income source and was, in fact, saved us from falling off the cliff billions of dollars, because had we had that revenue, had we not instituted that, we would have had a huge spike on top of our capital gains. But because
the commission didn't recommend the property tax.
Well, I'm trying to find out where the comments are coming from, and I'm trying to just add a little more, because I'm sure this is not the end of the conversation if we take anything like this to the floor, Mr. Chair. So I just want to be sure that my comments with regard to the stability that the property tax has created and the predictable revenue stream, and also that perhaps skewing that or trying to reverse it in some manner may in fact eliminate one of the goals or objectives here, which is to create less volatility. So thank you.
You testified that Ohio, while they don't call it business net receipt tax, it is like a business net risk. It's similar to what is being proposed here.
Right, and I'm not an expert in this area.
Right. Well, no, I was just asking if that was your understanding, because Mr. Parsky agreed that Ohio had a similar, a very, very similar tax. But you're saying that the revenue projections when that tax was adopted were 20% off.
Right, below the projection.
Below than
what was projected.
What was intended or projected to be.
Right.
All right. I don't want to get back in the property tax, but Mr. Parsky, let me ask you the same question. I asked that why the commission didn't present a bunch of options to the legislature. In other words, this is one package, and if you change, you can't change anything in it. If you change something, it gets off balance. So, so basically, how do you for the legislature to consider this? I think, and I got from him, not to say this is what he said, that you change any part of it and you're going to throw off the equation. But I asked him why there weren't a number of proposals. For instance, I mean, if you want to talk about something that will improve, that will be stable and will improve competitiveness for Californians, because it'll improve the business climate, because they won't be bearing the brunt of the tax. I said, well, why didn't you even take a look at the property tax? Why didn't you take a look at a tax on internet? Why didn't you take a look to see whether or not we might be able to change how we collect the use? I mean, I asked why, and he said basically, well, we wanted to give you a practical proposal that we thought would work. And for property taxes, he says, well, it was just too complicated in terms of how the taxes are collected at the local level, and ultimately how the localities spend the taxes. So what is your response to that?
Well, I was surprised. Yeah, we did have a full session and had testifiers to talk particularly around the property tax. I mean, I too was surprised that and I believe that fellow Commissioner Keeley will talk to you about the blue proposal that was put forward, the red, white, and blue plan that was put forward. I mean, none of those elements, from my perspective and in my experience, the primary agenda being driven through this process was this drastic $15 billion reduction in the personal income tax and the elimination of the corporate tax. And so these other proposals were ways to try and fund that. And I mean, if we were going to go forward, had I known that we were just going to move forward and that consensus was not necessarily going to be around was not necessarily going to be an endorsement of the recommendations, I think that we may have been able to provide a better service for the legislature and for the governor if we had put together a menu of options.
If I did get the impression, though, when he was testifying, that they did ask the question about who wanted to look at Proposition 13 and didn't see a hand go up. Remember that one?
Is that your?
That was in the final hearing, and by then, I mean, I was under the impression that it would not have met the threshold of getting 3 commissioners, and 1 from the governors and 1 from the legislative appointees.
So you didn't think it was politically practical?
Right.
I had a question that flew right out of my ear. All right. Was that approach discussed in the commission, in other words, and dismissed? I don't want to put words in Mr. Parsky's mouth, but what I got from his testimony on that issue was that that it was considered, but that they wanted to give the legislature a practical recommendation that could work, and so the commission decided to go that way as opposed to going for a menu of options. Is that how you understood it?
That's my understanding, was that there were proposals that span the spectrum, and that those at property tax being probably at the left side of this little spectrum, if you have, was one of those that would drop off, as well as on the other side, the pure flat tax was also proposed at one point, that continued to be a driver, but was also, what you see before you in terms of this 2-bracket structure, I believe, was the compromise.
Mr. Parsky said he didn't want to take, obviously it's up to the legislature to decide, and he didn't want to, invade the province of the legislature. However, I was struck by the proposal and how limited it is in terms of what the legislature can and can't do. And so, would you agree with that assessment?
I would agree, and that's why I really appreciate you holding these informational hearings, and at the end of the day, we'll make your decision about how you move forward. My recommendation is that this is not the right direction to move in.
But you're understanding that this is clearly the direction. See, I just don't know what. There'll be commissioners here. I'll ask them tomorrow, but I just don't know what this report is out, and so what does it mean in terms of the commission? A statement by the commission, and I am not. And it's that. Well, this is something you should consider, but there could have been a menu of things that we could have considered, and that didn't happen. So I'm still trying to figure out whether a vote for this was an endorsement of it. And anyway, I don't want to get too far afield, but do you have any statement in response to that?
Well, it was my, and I talked at length with Chairman Parsky around this, and I feel like a signature, there was not even a vote, so I can't even say that there was a vote, but an agreement to sign on to this report is an implicit endorsement of the content and the recommendations moving forward. That's my decision not to sign on. I don't know if that...
All right, well, I can't, it's probably, either no foundation would be the objection or relevance. Anyway, thank you very much.
Great,
Any more questions by committee members? No. Yeah. Right. Where's his bio? Mr. Keeley, just by way of housekeeping, we have we're running behind. We have legislative counsel who, legislative analyst who needs to testify at 3:15. So what I'd like to do is...
Do I take them now?
No, have you start. And at 3:15, we'll bring up ledge analyst. He will take 30 minutes. Will that... And then I'd like you to come back. Would that present a hardship to you?
Not at all, Mr. Chairman.
Okay. Well, let me first of all thank you on behalf of California for the time that you have given to this endeavor and for your energy and your contribution of your creative juices, if you will. And I want to read a little bit about your background. You served as treasurer of the Santa Cruz County. I'm not telling you, I'm telling everybody else. You know. Mr. Keeley served as treasurer of Santa Cruz County since 2005, and also works as a political science professor at San Jose State University. From 96 to 2002, he served as a California State Assembly member, where he also served as Speaker Pro Tem of the Assembly. Prior to that, Keeley was executive director of the Planning and Conservation League and the PCL Foundation, and served the Santa Cruz County Board of Supervisors. He served as Chief of Staff to Assemblymember Sam Farr and was a Policy Director for Santa Cruz County Supervisor Jose...
Joe Kuchera.
Yeah, I can't. My glasses are... He serves as chair of the Voices of Reform Project of the Commonwealth Club of California and is a member of the California League of Conservation Voters Board of Directors and Planned Parenthood Advocates for Northern California and Nevada. Mr. Keeley earned a Bachelor of Arts degree from San Jose State University. Welcome, Mr. Keeley.
Mr. Chairman, thank you very much. Mr. Chairman, Mr. Vice Chair, Assemblymember Cotto, Assemblymember Ma, thank you very, very much for the invitation to be here today. I first want to associate myself with every single comment made by my predecessor here. She served with great distinction on the commission, and every comment she made in her opening statement, I associate myself with that, and that might save us a little bit of time. I would like to make a couple of comments, Mr. Chairman, then I'd be glad to answer questions. I think that it is absolutely essential to recognize the very, very hard, good, high-quality, professional, unquestionably fair and honest work done by the staff of the Commission. Those that were from the Department of Finance or any other part of the executive branch of state government served the Commission with great distinction, and whatever disagreements I have on policy, they do not go to the quality of the work presented and undertaken by the staff. They are outstanding folks who have done exceptionally fine work. I also want to associate myself with the comments of Ms. Ito relative to our colleagues on the Commission, whereas I believe we can have principled disagreements with each other, sometimes vehemently principled disagreements with each other. The commissioners themselves are honorable people who I believe from their belief system and their point of view that they were advancing policy arguments and policy recommendations that are consistent with their point of view and their belief systems. Mr. Chairman, I'd also like to thank, acknowledge, and appreciate all of those who testified in front of the Commission. We had some extraordinarily well-informed, thoughtful folks who testified in front of the Commission, and it was very helpful to the work of the Commission. Like Ms. Ito, I was not one of those commissioners who signed the final document that was forwarded to the Speaker, the President Pro Tem of the Senate, and the Governor. My reasons for not signing are quite similar to those of Ms. Ito. So I will associate myself with those comments, but I'd like to perhaps go on to a couple of other issues that I think are quite important. First, you all serve on the Rev and Tax Committee, and I don't mean to be patronizing or to state the obvious, but let me see if I can do something a little bit better than that. I think with respect to tax policy, and especially when talking about tax reform, it is very important to understand what we are managing towards. Mr. DeVore may have a very principled set of well-formed beliefs, and I believe you do, sir, about what tax policy should be trying to achieve in California, what it is encouraging and what it is trying to discourage. I think Mr. Calderon, from your service in the Assembly and the Senate and back in the Assembly now, you have a very well-formed belief system about what the tax system should be doing. I think that at the outset, the Commission suffered two fatal points. Number one, the Governor's executive order was clear on 2 points in terms of what we were supposed to be managing towards. There are, on the second page of the Governor's executive order, items A through E, 2A through 2E, and they define what our task was. There are two of them, however, that are really what are you managing towards, as opposed to, if you will, rather glittering generalities about fairness and so on. And those 2 points are these: that we should be trying, in essence, these are my words, not the Governor's words, to slay the revenue volatility dragon. That is a very bad thing in California, and that we should, through tax policy, try to slay that dragon. Number two, that we should be developing a 21st century tax structure that is consistent with California's 21st century economy. So if I might take both of those for just a moment. With respect to the volatility issue, it would be foolish to deny that there is revenue volatility in California or in any other state, or in the county where I am, Santa Cruz County, where I'm the elected county treasurer. Of course there's revenue volatility. Now, how to deal with that revenue volatility, I believe very reasonable, thoughtful people can reach very different conclusions. There are those who have a belief system which tells them that how you deal with that issue is that you deal with it as a matter of tax policy. That what you would want to do to reduce volatility is to reduce revenue. And by reducing revenue, and especially in the most volatile areas of revenue, you will be able to reduce volatility. I think there's a couple of issues there. One is, you do change the volatility, but I'm not sure that you reduce it when you do that. An argument can be constructed, and evidence was presented to us in that regard. But I think the more important issue, from my perspective, is that another belief system says that instead of attempting to deal with volatility as a tax question, it's a budgeting question. This is a matter of revenues in and expenditures out, and at what levels do you, as reasonable people who can reasonably disagree on what those levels ought to be, then where is your comfort level at living with that revenue volatility relative to the expenditures? That is pure and simple, not tax policy. That is fiscal policy for the state, and you have an absolutely critical role in that regard as legislators. But I don't believe in the Revenue and Taxation Committee. I believe that that's true in the Budget Committee. And I believe this is a matter of budget policy and fiscal policy, not a matter of tax policy. I do understand how reasonable people can get to a different position on that, but that's my view. Secondly, with regard to the issue of what are we managing towards relative to massive, massive changes in the tax policy of the state, and that is what is represented by the package that was submitted by less than 2/3 vote of the Commission. What is presented to you, Only when I come back to the legislature could I make a statement like that and then have someone say, I'm glad you support the two-thirds. I don't think I said I did, Mr. DeVore, but I feel back at home again. Thank you, sir. Welcome home. Thank you, sir. Let me take the governor's point on this and comment, if I might, Mr. Chairman, Mr. Vice Chair. When the governor says, I want to see a 21st century tax policy which matches the 21st century economy, I think there are fundamentally two ways you can look at answering that question. One would be by looking through the windshield, and one would be by looking through the rearview mirror. And what I mean by that is a very legitimate way to do this, to answer that question, is to say, what is California's economy today? How did it get there over the last 10 years? And take that and project that out into the future. It's essentially a static model of how you would do it. An alternative to that is to say, what do we want it to be? And I'm not suggesting that we engage in the last great Stalinist experiment in central planning. My argument is different than that. It's that if you have an aspiration about what you want the economy to become, then that would lead you in a very different set of directions than to simply say, what has it become and how do we keep it moving on that track? Example. Let's say that what you wanted to do from an aspirational perspective, and I recognize, again, reasonable people can say, well, that's not my aspiration, but let's say that what your aspiration was is this, is that you believed that when you looked at the history of the California economy in the last 100 years, that what you concluded is that the single thread of the dynamic component of California's economy has been our ability to make very significant change and lead the nation. That is a possible conclusion looking back at the last 100 years of California economy. Examples would certainly be post-World War II and the movement into the aerospace industry and how that led the nation. You would also be able to do that with regard to the very high number of world-changing products that were taken from the intellectual capital at the University of California and Caltech and Stanford and others, coupled with venture capital taken to market in the high-tech industry, which changed the world on at least two different occasions. One thing you could do in looking at that is say that the greatest economic opportunity facing the world today is going to be the combination of intellectual capital and venture capital to solve the global climate change challenges. And that there will be billions of dollars of profits made on trillions of dollars of investment in California and in the world. And that California is uniquely poised among all of the states and perhaps most nations to be able to make that harmony come about. That would be an aspirational way to look at the economy. It would also be a recognition, whether you like or don't like AB 32, SB 375, whatever it might be. But what has happened in the state of California is that there has been a very, very significant exercise in leadership by the legislature and this governor and his predecessor on the issue of global climate change. When the federal government was not leading on that, California did in a bipartisan way and continues to do that today. You may agree or disagree with the particular strategies that are being employed at the ARB or wherever it might be, but this is clearly an area where tax policy is absolutely relevant. Now, at the Commission, we did not have the discussion that we hopefully will have right now, or that you may choose to enter into at a later date. What are we managing towards? When we talk about reforming the tax system, what are you trying to accomplish with that? You want to do what for whom in order to get what kind of behavior out of that? More revenue, less revenue, revenue shifted. You want to encourage some industries, discourage other industries. You want to encourage all industries and discourage, are you taxing consumption? Do you want to tax labor? Well, those are in pursuit of what? And that's a conversation that, in my judgment, should have happened at the very outset of the Commission's work. And if that took 2 or 3 Commission meetings to have that, so be it. The conversation simply didn't happen. And when I had the privilege of serving in this House, and I had the privilege of serving on the Budget Committee, I had an exceptionally talented staff member who served the Senate and the Assembly very well over the years, both Republicans and Democrats, who said to me early on, with respect to the budget, if you don't know where you're going, any road will get you there. And so I think the same thing happened on the Commission, that the Commission didn't know where it was going. The opportunity to discuss where are we going, what are we managing towards, was not had. And therefore, it was any road was okay as a consequence of that. Secondly, without even getting within 100 miles of impugning the character or integrity of the chair or the other commissioners, I would, after 30 years in public life, have selected a very different set of processes for conducting the Commission's work. I think that it is not a unique hallmark of California government, but it is a hallmark of California. It is a touchstone. It is a principle of California government that we do our work in an open, transparent way so that everyone who chooses to participate in any way, shape, or form can. I would argue that the Commission's processes did not permit that. And starting at the level of not really allowing that to happen among and between commissioners. Let me give you an example. We had, I believe, 9 meetings. At 8 of those meetings, not one piece of paper was made available to a commissioner until the day and the moment that you walked into the meeting. These are meetings at which several 100-page packets were handed to commissioners when they walked into meetings. I know that that is not shocking to you, perhaps, but I will point out that one of the... However, what I will point out is that the legislature does not function under the same rules that a public commission does. The commission is governed by the Bagley-Keene Act, which is very much like the Ralph M. Brown Act for those who have served in local government. The commission is not allowed, in my judgment, to have several hundred pages presented to the public and the commission at the moment they begin their hearing. Because what happens in the hearing as a consequence of that, when you do it that way, is that the quality of the participation of the commissioners is significantly diminished. It means that all the commissioners can do, literally, is try to understand what the staff presentation is about the materials that are in front of them and see if they can ask some clarifying questions. There is not the opportunity to digest the material and prepare thoughtful questions that would add value to the proceedings of the Commission. I think that was a significant impediment to the work of the Commission.
Actually, I think he sounds like a Republican. Sorry, that's inside. That wasn't a comment about
That's
you.
because he felt
We hear that all the time
outnumbered.
about Republicans not having enough time to review documents. Yeah, okay. And we have a minority speaking, right? Okay.
And I held this position and communicated it with the chair before there were majority and minority positions on the Commission. Next, I believe that in the evolution of the Commission's work, that what we saw were some initial hearings to familiarize the commissioners with the existing tax structure. A very useful thing to do. What is a sales tax? What is a property tax? How do they work? What are the bases? What are the rates? How are they distributed? How does this all work? Those are very helpful. Without much debate, discussion, or comment, what then appeared in front of the Commission was a fully formed business net receipts tax, together with other elements of a package. I have no objection to the chair doing that in the context of being able to say, now that we've had a couple of meetings, let's get focused and start a discussion. The unfortunate aspect of that, in my judgment, is that virtually all other ideas were frozen out once that package was placed on the table. I think that's quite unfortunate. That did cause a number of folks on the Commission, myself included, to develop something called the Blue Plan, which is attached to my testimony and the letter to the President Pro Tem. That was our attempt to essentially even up the discussion so that there were bookends on the discussion. What ensued from there, procedurally, that I think, again, is quite unfortunate in terms of the Commission's work, was that then all resources, and I don't mean most, and I don't mean 90%, I mean all resources available to the Commission were put into continuing to develop and continuing to advance the package that you have in front of you from the Commission. I don't think that that's a real good way to proceed. That also includes the Commission, someone on the Commission, perhaps a chair, I have no idea, retained the services of Ernst & Young. I have no idea under what circumstances. I have no idea if there was a contract. I have no idea what their work, who directed their work. But Ernst & Young presented substantial documents. This is not an attack on Ernst & Young. Their work was quite good. It was very thoughtful, good work.
There was no vote on it?
There was never a vote on that.
And there was not an agenda item?
There was never an agenda item. There was never an advance notice. There was never an agenda item before this happened. Now, again, I don't want to get, this does not go to people's motives. This goes to how some people think a public process ought to be conducted and how other people think a public process could be conducted. In my judgment, bad process is going to lead to bad product. I think it did in this case. Now, let me go. Mr. Chairman, would you like me to pause at this point and allow, whatever your preference is, sir?
The journalist has graciously agreed to postpone his commitments to allow you to finish.
Well, thank you to Mr. Hafer. I appreciate that. Mr. Chairman, the package that is in front of you, in my judgment, does little to effectively address the issue of volatility. And it does nothing, in my judgment, as a package to answer the question, what are we managing towards in terms of our vision of the 21st century economy in California? I think that there are two reasons why that's the case. One is, very early on in the Commission's work, the chair made it clear that a very fundamental principle not contained in the governor's executive order was going to be imposed and would be part of our guiding principles. And that is that the package, whatever package was advanced, needed to be revenue neutral. That appears nowhere in the governor's executive order. In fact, I met with Mr. Genest, Mr. Spielberg, with Mr. Crane on the telephone, in Mr. Genest's office, before the first meeting of the Commission after I was appointed by the President Pro Tem of the Senate, and asked them, among other things, what we were managing towards and so on. One of the issues that came up was that the package needed to be revenue neutral. I said that I didn't find that in the governor's executive order. We all read it. It's only 2 pages. They agreed that it was not in there and that it was a mere oversight. Well, the governor can issue another executive order and say that revenue neutrality is part of what we should have been managing towards. But there is no revenue neutrality in the governor's executive order. The reason that was given to me for why we needed to do that was because the President Pro Tem of the Senate was alleged to have committed, along with the Speaker of the Assembly, to the governor that whatever package we produced would be put up for an up or down vote on the floor of the House, of the Assembly, and the Senate, and no amendments would be allowed, and it would be like a base realignment and closure commission vote. It would be an up or down vote, and therefore it needed to be revenue neutral. I spoke with the President Pro Tem of the Senate. He didn't believe that he made any such commitment, and as you know, neither the President Pro Tem of the Senate or the Speaker intend to do that. Once that disappeared as an issue, revenue neutrality should have disappeared as an issue, but it didn't. I think that that again severely hemmed in what the Commission could be managing towards or what kind of package could be presented to you.
Well, what do you understand the purpose of that basic principle being adopted?
If the issue of revenue neutrality was in place, and if the Senate and Assembly were going to have up or down votes on the floor on the package, it is my understanding that the benefit of a revenue neutral package is that it could have been passed on majority votes of both houses.
Oh, but Mr. Parsky said he wasn't going to interfere with the legislative process in terms of how we decide to approach the issue, but that this was simply one option that commissioners thought were viable. But he said we certainly, weren't legislating.
Let me respond to that because I have a very, very different view than the chair does. The chair spent more than the first half of our lifetime as a commission insisting that any package being advanced would have to meet the revenue neutrality test. As we got into the latter stages, the standard for the package changed quite substantially. Let me give you an example in addition to revenue neutrality holding on as an issue, but disappearing as having, in my judgment, any justification beyond the question of an up or down vote. Once that disappeared, the logic disappeared, in my view. Let me give you another example. About a month before our last meeting of the Commission, the chair sent out an email to all members of the Commission saying that the chair wanted to now define what constituted a consensus, because for the first several months of the work of the Commission, consensus, according to the chair in public meetings, meant that everyone was signing on. In the latter stages of the Commission's work, when it was clear that at least one commissioner, Commissioner Pomp, was not going to be signing on to the package, the chair sent out a memo which said that he believed, and he would like feedback from the commissioners, that he believed that the standard for consensus for an item to be placed in either what was called Category 1 or Category 2 of the three categories of recommendations, that in order to get in Category 1 or Category 2, a concept would have to get at least 10 votes from the Commission in order to be placed in Bucket 1 or Bucket 2. To briefly describe those buckets, Bucket 1 are those actions that you and the Governor can take and enact. Bucket 2 would be those that you may act on but would need ratification by the voters. Obviously, think constitutional amendment. Third would be those that don't fit in bucket number 1, bucket number 2, but seem to be quite good ideas to the Commission overall and might be in the area of those kinds of things, for example, that California Forward works on in terms of budget and fiscal review, or other entities might be suggesting to you. The chair sent out a memo, again, which said, I intend to have a 10-vote standard in order for something to get in bucket number 1 or bucket number 2. Please advise your thoughts. My thoughts were that it'd be a good idea if a majority vote is a majority vote. I think every commissioner was appointed with equal authority and equal power. My thought was that. the chair disagreed with that as well. I understand that's not a problem. I do think it's interesting, however, that the final report has less than 10 members of the commission signing on to it, less than 2/3 of the commission, and that the 10-vote standard was waived, much as others principles evaporated over time at the commission. Again, I'm not going to motives or anything of that nature, or questioning anyone's integrity. What I'm questioning is whether or not a process that began with essentially no serious thought or discussion about what we were managing towards, a product delivered to the commission that the commission didn't ask for, an effort to essentially restrict the use of all resources of the commission to only that package and to nothing else that any other commissioner wanted to work on, and to then lower the vote standard from 10 to whatever you can get, and to have a process which has essentially little, if any, opportunity for the public to participate in it, and quite frankly, relatively little opportunity for the commissioners to participate in meaningful ways, you get a product that looks like the product you got. And I don't think it's a very useful product. I think it should be on the table for you, as I think the blue plan that many of us supported should be on the table for you, as I hope the testimony that I provided in written form will be on the table for you, and testimony from any other commissioner or any other source ought to be on the table. What I would urge you not to do is to use the commission's document as the base document for consideration of where this legislature may want to go in terms of major revisions to the tax system. Thank you, Mr. Chairman.
Questions? Mr. DeVore.
Thank you, Mr. Chairman. Thank you, Mr. Keeley, for your time and testimony.
Yes, sir.
I wanted to say that your initial remarks were very interesting insofar as the issue of volatility of your sources of revenue and whether or not the tax code is the proper place in which to address that. I tend to agree with your assessment that budgeting discipline, both in the legislature and in the executive branch, is superior in dealing with the volatility than is your tax code. Certainly, today's economy with its massive flows of capital gains, bonuses, stock options, things that really didn't exist in the form that they exist today over 100 years ago, obviously are a much larger percentage of the GDP than was the case, and so as a result magnify. Now, we may disagree over the effect of the higher marginal rates in accentuating that, but I agree with you that necessarily it's not the right thing to do to try to address volatility using the tax code. I would, though, like to say, and perhaps you can comment on this, as someone who looks historically at what lowering the rate did federally under John F. Kennedy in the early 60s and what the rates being lowered under Ronald Reagan in the early 80s did, what was fascinating to me is that the percentage of income taxes paid by the wealthier segments of society actually went up as the result of the additional activity that was occurring. And it struck me as precisely the sort of thing that we might want to do in California, looking forward down the road, with the fact that we are or do tend to be an economic dynamo in creating intellectual property and marrying that up with venture capital and turning it into something valuable. And that, to me, what we ought to be doing for a 21st century tax code is we ought to have tax policies and regulatory policies that say to the world, we want your capital and we want it invested in California to improve our productivity, to create new things, and to create jobs. And as that throws off revenue to the state, great for the state. One of the frustrating things that I find, and I'll leave it with this, and if you care to comment, please, otherwise I'm sure my colleagues will have something to say. One of the frustrating things that I find coming from the conservative standpoint is that many of my colleagues on the other side of the aisle have a hard time reconciling their desire for using the tax code to enact some form of redistributive justice versus what I think ought to be the case, which is how do you maximize revenue without dissuading economic activity, because those aren't necessarily the same things. You try to redistribute wealth, for example, and wealthy people tend to leave or not cooperate. And that, is the challenge, it seems to me. So I completely concur with your comments, though, about volatility, and that, cripes, I could see a situation where a great tax code might even make volatility worse, but have more capital being attracted to the state. I mean, wouldn't that be a nice thing, to have the problem of figuring out what to do because the whole world wants to invest their capital in California? I think that'd be a great problem to have, and I'd be willing to try to, rise to the challenge of how to squirrel away the money in the good times. So,
Mr. Chairman, if I might.
Yes.
Mr. Vice Chairman, thank you for your kind comments to me. Let me try to go to a couple of the points that you raised. First of all, I think it is important to recognize that the mythology versus the reality. For example, it is oftentimes stated that one of the reasons that the Commission should have and did recommend lowering the tax obligation on the wealthiest of Californians is because one of the things that was happening was that wealthy Californians are leaving California. There was not a shred of evidence offered to the Commission to support that claim. In fact, during the Commission's life, the Public Policy Institute of California submitted a report on this topic and said, with respect to the out-migration from California, it is primarily low and moderate income folks who can no longer afford to live in California. Secondly, with respect to tax policy overall, I think this again gets into belief systems that may be irreconcilable, but I'm not sure they are. For example, a fair way, I think, to look at the existing tax system is to say that what it does is it taxes things that we actually all could probably say we like. For example, whether you're a Republican or a Democrat, or even a wacky liberal Democrat like myself, what you do believe is that jobs are good for people. It's good for our communities, it's good for our neighborhood, it's good for families, it's good for the tax revenue, it's all good. A job is a very good thing. Yet what we do in California is that we tax the job. We tax the income. We tax the formation of capital. We tax those folks who are able to put capital together to create jobs. Now, why do we do that? We do that because, sort of like, why did John Dillinger rob banks? And it's because of where the money was. You go where the money is. I understand that. It is at least intellectually honest to say, if we all agree that taxing labor and the formation of capital, which helps create jobs, which is the engine that created the fuel in the engine that creates jobs, then we should in fact look at how it is we might be able to do less of that, or to do that in a different way. However, what I think you would have to do simultaneously with that is go into the other side of the belief system, which is that currently, in the United States as a matter of principle, we are not very much interested in taxing consumption. And we are very interested, apparently, in our tax system of allowing the externalizing of costs that fall because they are externalized onto the public resource obligation, and we pay for it in a different way. Example, excuse me, Mr. Chairman. Example, clearly that's the case with burning fossil fuels. You can agree or disagree on what we ought to do about that, but no one seriously argues that in the United States or in California that we pay as consumers the total cost of burning fossil fuels. There's no one who argues that case with any credibility anymore. In fact, what economists argue, including one of our colleagues, Commissioner Boskin, one of the most conservative folks on the Commission, has argued and has authored articles which show that the burning of fossil fuels at the current prices externalizes the cost of burning those fossil fuels and comes back and gets you in terms of public health costs and reduced productivity in terms of agriculture and all kinds of other issues. What do you want to do about that? It's a fair policy question. So the reason I say that, Mr. Vice Chairman, is to say I'm not sure we have a fundamental disagreement there. Where I have a fundamental disagreement with the package that is proposed, because you could say to me, well, wait a minute, doesn't this package reduce the tax on labor and the creation of jobs and increase the tax on consumption? And isn't that exactly what you just argued, Mr. Keeley? Here's what I would say to you. What I would say is, number one, the package has to be viewed in its totality. If you want to take out the BNRT and examine it, or you want to take out the piece on reducing the progressivity of personal income tax and examine it and do it in stovepipes, it's not a very helpful exercise, it seems to me. It is the package. And this package undeniably shifts multi-billions of dollars in tax revenue current obligation as a package away from the wealthiest Californians and to the less wealthy Californians. As a matter of policy and how it does that, you may choose, Mr. DeVore, or anyone else may decide. A reasonable person could decide that's a price worth paying, because what we will get from that is somehow some increased business activity and revenue, and people could claw their way back ultimately to, in terms of the losses in social service and education funding and so on. I'm not one of the people that would argue that, but I don't think that's irrational or crazy. It's just not my belief system. I think the package is a package which, if it were enacted as it's proposed, would have a very negative effect on California, even on those, and especially on those issues that have to do with jobs. Ms. Ito, I thought, did a very thoughtful job of describing why that's the case. If you want additional thoughts on that from folks who I think have some good things to say about it, some well-informed things to say about it, I would commend Gene Ross's work at the California Budget Project, Lenny Goldberg's work, Steve Levy's work at the California Center, the Center for the Continuing Study of the California Economy. Admittedly, those folks are closer to me in terms of belief systems, but I think they have some very thoughtful comments to make in that regard.
All right, Ms. Ma has a question, and then I'm going to ask you, Mr. Keeley. Oh, Mr. Cotto? After Ms. Ma, then Mr. Cotto, quick question. Then I'm going to ask you, Mr. Keeley, if you could yield the chair.
Of course, sir.
Legislative analyst, but stick around.
Yes,
Ms. Ma?
Mr. Chairman.
Thank you, Mr. Chair. It's not so much a question, but I am disturbed now. I thought that this package that came out was recommendations by the committee members based on a thoughtful process of all the recommendations that are out there. When I got elected to the Board of Supervisors my first year, I was disturbed because San Francisco is the only city and county that has a payroll tax. And so we actually penalize companies for hiring people and employing them, and thus they went outside of our city and county. So I convened a revenue advisory panel, invited anyone who wanted to be at the table to come to the table, and for 18 months we went through exactly the process that you talked about, explaining to members, what is involved, how do we generate revenues, and then putting up a whole set of options. And by the 18 months, we actually voted as a group, and we ranked them. And the top two went on the ballot. And I don't think anyone could have said that the process was bad, that people weren't able to express their opinions, good or bad. They were ultimately able to vote at the end in terms of prioritizing. And so I think we had a good process. And what I'm hearing from you is that some of the recommendations that were on the table were off the table, and that once this business net receipts tax was on the table, that's it. And that was the only thing that the Commission focused on, and not so much what are the options that are out there in the universe. And so now I'm a little bit disturbed about this. Secondly, when you talk about the full package, I think Mr. Parsky also talked about not bifurcating any of the portions of this package. Well, we as a legislature, I believe we presented a budget package that was revenue neutral. And there were arguments about whether it was constitutional, whether it was legal, and here we are again doing the same thing, presenting a proposal that is supposedly revenue neutral. And I'm interested to hear, what the arguments are going to be in terms of accepting this package versus why our budget compromise that was sent or proposed was not. So I look forward to that
I'm still
discussion.
curious about how Mr. Parsley got access to legislative counsel to get a draft bill that's keyed 41. The legislative counsel is not the governor's lawyer. But anyway, Mr. Cotto.
Yeah, but neither here nor there. Thank you very much, Assembly Member, for your excellent presentation. Well,
thank you, sir.
I really appreciate that a great deal. But I think there's some lessons here that we ought to, not lessons, but some lessons that we ought to learn from what the Assembly Member was saying, and that is that one of the things he expressed was that there was never a clear understanding at the beginning of the commissions about what you were trying to manage towards. So there was no sense of outcomes or objectives or what you were trying to achieve. I heard here, which is what I was looking for when I heard the presentations initially, the statement of several goals that this was trying to achieve. See, and I don't know whether those were goals that were stated up front or whether they were created as a result of the work of this document. So, Mr. Chairman, what I think is going to be very important for us to do is to not fall in the same kind of situation as what's been expressed here, but rather that as we move forward, we ought to also spell out for ourselves a very clear set of expectations or outcomes that we want to try to achieve. I mean, we've heard him say we should not limit ourselves to this document. There's a blue plan someplace out there. There's also this document that has been presented. We're going to hear other types of testimony. And maybe one of the things that we ought to try to get, that we ought to spend some time initially, Mr. Chairman, is for us as a committee to say, here's really what we're going to try to manage towards. Here's what we're going to try to achieve as a result of our recommendations, so that we spell them out very specifically. And then as we proceed to evaluate this or the blue plan or this document that's been presented here, we all have an idea about what we're trying to achieve, what direction we want to go to. Is it volatility? Is it the 21st century economy? Is it what was that? The revenue neutrality? What are the concepts that we're going to try to achieve, so that if we have a clear understanding of the direction that we're going to go, then all of this information ought to be utilized in terms of arriving at that. Because otherwise we're going to wind up near the end with a bunch of recommendations that may or may not focus on what we're setting out to achieve. I don't know whether that's clear or whether that makes any sense.
My fundamental question is, why are we using tax laws to reform government? That's what I don't understand, but we'll continue to hear. But thank you, Mr. Cotto, for your comments. And yes, we have alternatives, in that we're not locked into this proposal, which is merely, I'll ask the commissioners tomorrow, but appears to be merely a statement by the commissioners that here's one proposal for you to consider.
No, but I mean, see, I want to make sure I'm saying this right, because I may not be communicating it effectively. For our work as a committee, as a Revenue and Tax Committee, we at some point earlier on in the process rather than later ought to say, here's what we're going to try to achieve as we go through all of this process, so that we're clear about what we're managing towards or what our outcomes are about, rather than trying to piece it together near the end. And I think that's what I heard happened with the commission, was that it was never clear what they were management towards, so they limited a lot of other ideas that might have been included rather than just this document.
And I'm going to go ask Mr. Keeley to step down, yield the chair for just a second.
Yes, Mr. Chairman. Thank you, sir.
And ask Mr. Taylor to come up. But as he's coming up, I mean, how we had testimony from experts saying that tax law, was the worst way to stimulate the economy. Mm-hmm. And we're hearing today a tax proposal with arguments that it will allow for economic growth and stimulate the economy. But then we're trying to impact how we budget and spend by formulating the tax laws to limit the money that comes in, and any extra money goes into a rainy day account, which is why I was saying it sounds very, very familiar to me. But still, you know, we're going to look at this tax. We're going to take it line by line. But it is important and it is relevant to understand the process which produced this document, because you know, it's a lot of work to simply say, we as a commission think you ought to consider this as an option. And I think so far that's all I can determine that this means. It's not a complete review of tax law, tax policy, evolution of tax policy, and evolution of economies and how they have changed, and how the tax laws, which is the 1930s structure, can be shifted to then ultimately address issues of an economy that's changed from widgets to information, and what is the best way to do that, and how do you expand the base, and you know, who should bear the burden. I mean, you know, we didn't get that kind of analysis. We're sort of getting it indirectly by saying this is what we were thinking when we came up with this recommendation. But you know, this appears to be appears to be a statement. Vote for this because it includes everything, including language with a keyed by our lawyer as majority. So it's important to understand how this report evolved and how it came to be. Mr. Taylor, this is our legislative analyst. Welcome. I think is this the first time we've had a chance to talk to you, and we're 40 minutes late. I apologize, but I did want to sort of boast a little bit and talk about your resume. Because we're very proud. Mr. Taylor was appointed to the position of legislative analyst October 2008 as the fifth person to serve in that capacity since the office was founded in 1941. As legislative analyst, Mr. Taylor serves as a nonpartisan fiscal advisor to both houses of the California legislature and oversees the preparation of annual fiscal and policy analyses of the state's budget and programs. His office is also responsible for preparing impartial analysis of all initiatives and constitutional measures qualifying for the state ballot. Mr. Taylor earned a bachelor's degree with highest honors in political science from the University of California, Riverside, and a master's degree in public affairs from Princeton University. He serves on the statewide leadership council of the Public Policy Institute of California. Mr. Taylor resides in Carmichael with his wife, Sherry. They have 3 children. So welcome to our committee, Mr. Taylor.
Thank you very much, Mr. Chairman and members. Your day has been long. I'm going to be brief, but I would like to just offer some kind of initial observations and impressions that my staff and I have in reviewing this. Obviously, we have a lot of work to do, too, and we hope to be of as much help as we can to your committee in the coming weeks and months. But just for now, let me just give you some initial impressions, if I could. First of all, in keeping with, I think, all the speakers, I think the Commission did a very commendable job, and I think they do deserve a lot of credit for what they did, for a couple of reasons. If you read through the report, I think they laid out the problems that exist with each of the taxes, that there's quite a bit of consensus about the major problems for each of the taxes, and I'll go over those in just a second. They proposed in their solutions both kind of traditional ways of reforming taxes, and I think the personal income tax is the best example, where they've suggested you broaden the base and lower the rates. If there's one thing that you could probably get almost consensus on amongst economists, it is do that. Keep your bases as broad as possible and your rates as low as possible. But then they also included, as you noted, Mr. Chairman, a very bold approach in coming up with this business net receipts tax replacing the corporate in part of the sales. And I think that kind of out-of-the-box thinking is really helpful. I think it's good it really forces all of us to kind of think about, well, what are our kind of preconceptions that we have about what a good tax system should be? How might we think about it otherwise? And I think having this debate is really healthy. You get perspectives like Mr. Keeley that gives you a different view of that. And I think all of that is very helpful. So no matter what comes out of this, I think it can help us think better about our tax policies. I had the pleasure of speaking at the first commission meeting. And at that time, I noted that I didn't think our system was broken. And for all the things that I might agree with Mr. Parsky on, I think his characterization of a tax system that's outdated, I don't agree with. I think we have a decent tax system. It's well established, it's well administered, it has broad basis. When you think about it, we tax income, we tax consumption, we tax wealth through our property tax. Those are all very broad basis of ability to pay, of economic activity. And our tax system has generated revenues that have basically grown with the economy. Now, you can feel like it should grow faster, it should grow slower, whatever. But I think by anybody's measure, that's pretty good performance. Now, I don't want you to think that I don't think there are problems, because, again, the Commission outlined them very well. Volatility, kind of at the top of most people's list. We first wrote about this back in 2005 in a report that we put out that identified both the growing volatility and the problems with it. And at that time, we stressed the budgetary solution, that you should look first to budgetary approaches to dealing with volatility, just like the exchange, I think, with Mr. DeVore and Mr. Keeley a moments ago. And you can do that with a constitutional amendment, without. You can just do it with your own process. Then in the future, when we grow faster, you set aside the monies. It's not that hard in concept. It's difficult to achieve, and it's going to be difficult to achieve if, let's say, 3 years from now we're back growing rapidly. There's going to be lots of demands that people are going to want to restore program reductions that have been made, and it's going to be very difficult to take that money that's growing faster than your historical average and put it aside. We all recognize that. And I think that's why there have been attempts to do it constitutionally. The problem with that, of course, it's very difficult to get all the details right, to get something that's easy to explain that works fairly straightforwardly. But I would agree that budgetary solutions are a key way to try to solve your volatility problem. Now, I also agree with Mr. Parsky that our volatility may have gotten so large that you can't do it alone through budgetary approaches. And so I think it's well worth looking at ways that can reduce your volatility in the revenue system as a complementary step. The report also identifies high marginal rates. And there's no question the state's taxes are all very high, our marginal rates. And individuals in business react based on marginal rates, not on average rates. And so I think you should be concerned about that. There's no question in my mind. They raised the point about narrowing tax bases. Now, this applies basically to the sales tax. And there's no question that the sales tax base has diminished over time. And that's a concern. It's still a broad-based tax, but it's something that, you can address. And finally, all of our taxes have concerns with the unequal treatment of businesses in various ways. Whether it's our corporate and income, we have proprietorships, partnerships, S-corps, LLCs, regular corps. Business income is not treated the same. Business property is not treated the same at the local level under property taxes. New businesses there's this distorting effect because they will pay higher property taxes on their property than old businesses. And that's a concern. And I would just note that how you weight these problems in large part may determine what solutions you want to adopt. And there's certainly not going to be unanimity, as you've seen here in your discussion today from your witnesses. And so dealing with that kind of uncertainty and people's different weightings, it's going to be frustrating for you, but it's just something you have to deal with. Let me spend just a minute on volatility. I think I probably have to disagree with Mr. Keeley on this one. I think this system that the Commission has proposed would definitely reduce your volatility. And that's because it's eliminating the corporate tax, which is fairly volatile, and it's dampening your personal income tax, which is highly volatile. So I don't think there's any question it would reduce volatility. The question is, and maybe this was in part what Mr. Keeley was getting at, is it doing it in the best possible way? And I've already mentioned that we've written on this, and we really think you should always start with your budgetary approaches and then turn to other steps. You've talked a lot about tax incidents, but maybe not as directly as you need to, because this is really a crucial area, and it came up in the Ernst & Young study that the Commissioner Parsky and Mr. Eibel talked about. Let me just reinforce, though. The focus should not be on who pays the tax, it's on who bears the tax. And anytime you get someone coming up here worried about those corporations that are not paying their fair share of taxes, I think you should hark back to Mr. Eibel's words, is that corporations don't pay taxes. People pay taxes. Either workers, taxes being shifted back, consumers, prices shifting forward, owners of capital. And I think Mr. Eibel did a really nice job of explaining that. But it's important to remember when you get people to come up and come off with a line like that, I'm worried because businesses are getting away with something. Well, they should be worried about the ultimate incidence of the tax. And as Mr. Eibel also, I think, did a very nice job of saying that we have fairly good confidence in knowing the incidence on the personal income tax and on the sales tax. We have much less confidence on the proposed business net receipts tax and on the corporate tax. There's just not consensus about how that is born, how it is shifted. And it can vary dramatically depending on whether you're an in-state firm, whether you compete nationally, internationally, the demand for your product. So it's really hard to give you simple answers to the question of who bears the tax in some cases. But I think their proposal, or their information that they're going to be providing on incidents will be very enlightening and helpful to you in your deliberations. And I think Mr. DeVore mentioned about the kind of dynamic effects or the second-order effects, because the Commission, I think out of necessity, just did a kind of static analysis. More dynamic analysis, second-order effects are really important in this area, because the Commission is claiming that this will be better for the economy, and you have to be able to play out how the taxes will affect business activity, personal decisions, in order to kind of confirm or deny that. Let me just caution a couple of things on tax incidents, because you're going to get a lot of people coming up in the next few days or weeks talking to you about their concern with the proposal. And of course, you're going to hear more vociferous concerns from the losers, right? Because you're always going to have winners and losers in any major change in your tax system. And I think it's important that you press those people, not just that they're paying more taxes. You need to press them as to why is that necessarily a bad thing. It may be that we feel like we're ending some type of distortion, or they're getting a benefit now that we don't believe they should get. In that case, they should pay more taxes. So I think it's real important to press those people as to, well, despite your own situation, is it better for the system as a whole, for the state as a whole? Let me also comment a little bit about progressivity and regressivity, because, Mr. Chairman, I think you had lots of questions that really speak to that point. Because I think it's unfortunate, because the terms for most people have such a negative or positive connotation, right? Something that's progressive is good, something that regressive is bad. The way that tax economists use the term, it's in a completely objective, descriptive-only way. A tax system is progressive if the tax rate increases with income, and it's regressive if it decreases with income. That doesn't mean that under a regressive system you don't pay more, you just pay a lower percentage. And let me just give a real simple example that I think, Mr. Chair, you were speaking to. Let's say that you earn $100,000 and I earn $10,000. You pay $11,000 in tax, I pay $1,000 in tax. Well, you're paying an 11% rate, I'm paying at a 10% rate. That's a progressive, slightly progressive system. Now let's say that you pay $9,000 in tax and I pay $10,000 still. You're paying at a 9% rate, I'm paying at a 10% rate.
Yeah, but I'm only making $10.
No, you're paying at $100,000, I'm making $10,000. Yeah, you're making 10 times I am, you're just paying only 9 times more in taxes. You're still paying a lot more in taxes than I am, but the percentage of your income is somewhat lower. So people, I think there's this assumption amongst many people that progressive is good, regressive bad. It may be. I mean, you can make a case for it. It's just that having a system that by changing it is either somewhat more progressive, somewhat less progressive, is not necessarily good or bad. That's going to depend on how you value your just value system, really. And I can make a case, I wouldn't be a proponent, say, for having a regressive system, but you can make a case that you could have a reasonable tax structure that was regressive, especially if you took into account how you spend the proceeds of those taxes. So again, Mr. Chairman, in our system, maybe I'm paying 1,000 or 10% of my taxes. You're paying 9%. But let's say that the money that's raised by the two of us is basically going to subsidize me, my health care, my education. I might, on net, be much better off. I might not have any effective tax liability. So after taking into account expenditure, the expenditure side, that's really important. You may not consider that regressive overall. So anyway, I just raised this because it's going to come up a lot, and some people, for example, have already raised it. They're bothered by the fact that millionaires will get a bigger tax break. Well, then that's fine. They can make a case for that based on their value system. The fact that it's less progressive, though, does not necessarily mean that it's bad. You could have people that are concerned that they're just paying too high a share, or that they're concerned about the distorting effects of high marginal rates, Mr. DeVore's point, that you'd be better off with lower rates for either of those bases. So just be aware of that people use those terms differently from, I think, the way that economists intend to use them, which is purely descriptive. The business net receipts tax should be an important focal point of your deliberations. You're basically replacing one tax, almost eliminating another, and using it to subsidize another. You're going to raise about $45 billion. It will become one of your largest taxes.
$65 billion, according to Parsky.
Was it 65?
He said 65. Now,
just for the business?
I'd say 45, but...
Okay, well, we haven't seen the final numbers. I thought it was more. But anyway, it's going to be large no matter what. And you have a tax now that is not based on ability to pay like an income tax or a corporate income tax. It's based on just your activity. And that's okay. The sales tax is not based on an ability to pay. It's based on what you consume. But now that you have a tax that's much, much larger, you're going to have to be more concerned about both the rate, and which is, I think, why Commissioner Parsky was saying they'd love to have a much lower rate than 4%. And I think that's for good reason. You're going to have a lot of businesses that currently do not pay any taxes. Roughly half of corporations do not pay taxes. Under this plan, they will be paying taxes. Again, not good or bad, it's just something you have to be aware of. The impact of the tax on different types of business will vary dramatically. Services will be much more affected because their labor and profit is a much larger percentage of their gross receipts than a business that is highly capital intensive. Again, not good or bad, but you have to be aware of the disparate effects on those businesses. And clearly, the lower the tax rate, the lesser the distortions of whatever tax system that you have. Just briefly, I think there were some missed opportunities. Certainly, Mr. Keeley mentioned some of these. I think the property tax is an area that you should feel free to engage and explore changes that you can make in it. It's a key state local tax source. It's almost as big as our income tax. And you've already talked about some things that have been considered, and I think that's entirely appropriate, not only because the linkage with the state through our Proposition 98 and funding part of schools, but because it's such a crucial funding source for local governments. And also, just let me raise very quickly, the bit of the strangeness in getting rid of the state portion of the sales tax, but leaving in effect the local. I don't know if this was, they kind of ran out of time and they didn't quite know how to deal with the local aspects because they didn't want to interfere with that aspect. But it is kind of strange. You're going to have the same administrative apparatus as business. They're still going to have to go through paying their sales taxes, but just for a relatively small share. And it's going to leave the state in control of this, what is now a completely local revenue source, which isn't kind of ideal. So finally, just some final points. I really appreciated all the members' comments at the start of the hearing. I thought it was very constructive that you have an open mind, and I think that's a good thing. I think you should be open to these proposals. Similarly, you should be open to other ideas, as Mr. Keeley pointed out. I don't think you should be turned off by the complexity of the business net receipt tax. It's a little bit daunting. There's legal, administrative, economic issues you're going to have to deal with. But I can guarantee you, if you'd been here at the start of the state corporate tax, you would have been astounded by the complexity of that tax. So by itself is not a reason not to consider it, but it is going to pose a lot of concerns and issues for you. I'd like to kind of end on a point, Mr. Chairman, again, that you've raised several times. And that's kind of this, you have to kind of go up or down on this package. And I think the Commission, again, should be given a lot of credit for providing you with a package that does hang together. That was admirable. But that doesn't mean you have to adopt it up or down. You can take pieces of it. If you wanted to just take the personal income tax portion, that's well within your purview. You may want to switch around some of the taxes. Let's say that you want to get rid of the corporate tax and replace it with a business net receipts tax, but you don't want to get rid of the sales tax. Maybe you have a much lower rate, 1.5% or whatever, and you buy out the corporate tax. Maybe you buy out the business payments in the sales tax so that you're not taxing business inputs. You can do all sorts of other things. You can take their proposals and play with them. For example, in the personal income tax, they have left three, they characterize it as just leaving three below-the-line deductions. However, those are three huge deductions: mortgage interest, property taxes, and charitable. Those are important ones. The mortgage deduction presents its own kind of problems because people have made commitments based on that. Maybe you phase that out, but you could consider not allowing any deductions and lower your rates even further, or not have the reduction as much in the pit and using the elimination of those deductions to achieve the same type of rate reductions while not fundamentally changing either your distribution, your incidence of the tax, or how much you raise from the tax. You have all sorts of options. So I don't believe, Mr. Chairman, you have to view it at all as it's an all or nothing. Take whatever pieces you want, add, mix them up. You're the legislature. You should do whatever you think is best. So with that, I just say that we have in the office a lot of work to do, and again, I hope that we can be of assistance to you in the coming weeks.
Thank you, Mr. Taylor. I mean, if the issue is volatility, there's two ways to do it, I think. Just if you don't have any taxes, then you don't have to worry about the volatility. Or get a tax base which is predictable. The property tax base is predictable. Business net receipts, I don't know how predictable that's going to be in the future. It could if we adopted it one time, but if Ohio is any measure that has a similar tax, they've been off on their projections according to some of the testimony here. And volatility, you know, it's inherent in government that government develops programs based on revenue projections. No matter how you tax, and revenue fluctuates. This particular tax wouldn't fluctuate as much because, you know, businesses will be paying the tax whether they're doing well or not.
That's right. It'd be much more stable.
So it'd be much more stable in that regard. But in terms of the business climate, in terms of how it impacts jobs, and in terms of that part of the charge, there are trade-offs involved. But it seems to me that if volatility there's going to always be volatility. I don't see, maybe you can limit it or reduce it, but you reduce volatility by simply putting the money away in good years, to some extent, if I understood your...
Well, but again, Mr. Chairman, I think in fairness, the property tax was much more volatile before Prop 13. So there was a change imposed on the system that did a lot of things, again, good and bad, but it did make the property tax much less volatile. So there are things you can do. You don't have to accept there's volatility in all taxes, but you don't have to accept it. There are things you can do to dampen it somewhat. And again, I'm not fundamentally disagreeing with you. I would start with budgetarily, approaching it that way. But I think it's also reasonable to look at the proposals that would help you out in reducing the volatility on your corporate and personal income taxes. I think that's a very reasonable thing to do.
Well, does it make, what do you think about the fact that if we did the business net receipts tax, it would be tying it to an economy that's growing at a slower pace than we're now taxing? And so therefore, would you agree that the growth rate would be slower?
You mean the overall growth rate in our revenue system?
Yeah.
I think that's probably safe to say that it would be somewhat less progressive. By definition. I mean, that's what you're giving up, and as Mr. Parsky stated, that's the fundamental trade-off on the pit, on the volatility versus the kind of robustness of the tax. I'm not sure it's a huge trade-off, but it is definitely there.
how does that impact our, how would this, Mr. Parsky thought that if this proposal were in place, that we would actually have avoided $15 billion in cuts.
We haven't had a chance to look at how they came to that conclusion. So I'm sorry, Mr. Chairman, I can't comment on that now.
But it certainly raises questions if you're taking a tax system and tying it to a slower growing economy than it currently is.
Well, and again, I think what they would argue is that it might be slightly less elastic is the term, but growing in relationship to personal income. Now, they've argued that they think that there will be greater growth in the economy because of the incentives. Again, we haven't been able to evaluate that. So they might say there's a little bit of a trade-off. If the direct relationship between the revenue growth and the economy is slightly lower, they might say it's more than made up with a slightly faster growth in the economy. And again, we haven't had the time to assess that kind of claim.
Well, I really appreciate your comments, although the only thing I take away from that is that next time we need to hire a one-arm. Anyway, but thank you, Mr. Taylor. Oh, Ms. Harkey.
One of the comments that I've listened to, and on yours, I like the incidence of tax, and actually what are the ramifications of it. But we are in this state, I think, for the next at least conceivably 3 to 5 years, going to be managing our cash flow from debt. And there's going to be very little avenue for us to borrow and do other things because we're really going to be plugging the holes of the debt that we've created, that we've tried to cut. And so we're doing short-term issuance of debt, which we're seeking capital markets for to try to just keep the state afloat. Okay, so I've analyzed this and I know that you agree with that. One of the blue proposal suggestions that I would like to look at is suggestion number 2, which assigns capital gains revenue to be apportioned as 1/3 the moving 5-year average to supplement the general fund, 1/3 to pay for debt reduction, since we're going to be operating on debt just to pay for our current ongoing expenses. We need some debt defeasance. And the other would be pension liability or other, and remaining 1/3 allocated to a rainy day fund. I like the debt defeasance, I like the rainy day fund, and I like using part of it for the ongoing, because we are so underwater and will be for the next at least 3 years, probably closer to 5, that for us to even suggest increasing revenues so we can add services back, I think is wishful thinking on some people's parts. I mean, we've got huge debt, and our treasurer actually, Mr. Chairman, has stated to the bond markets that we're going to have probably, I think it's $56 billion in deficits to pay off over the next 3 years, or to try to figure out how to finance. So I really would like to see this added in somehow. I would be glad to talk to the chair, but this is something I think we really need to consider, because I've tried to either get rid of capital gains to level it out, but I think for the next few years we might want to reallocate it such that it's reducing our debt so we can borrow again, so we can keep the state afloat, because that's kind of how bad we are.
And I think the Commission looked at the whole capital gain issue. Should they consider options related to that, lowering the taxes the federal government does on those? That reduces volatility also. Your approach would be to say that, and I wouldn't limit it just to capital gains. I'd have on any kind of any type of growth over a certain average level.
Rid of it, but we're not.
But those are different approaches too,
Right.
and you should consider all of those. But at the very least, this above-average growth, take it off the table. Now, whether you keep it all for when you're below your long-term trend line, just to keep you kind of whole or constant, or as you're suggesting, take pieces of that to pay off some of your debt. I think both of those have merit.
Yeah, because we're going to be constantly in this credit card mode, if we can even get the credit.
For quite a while.
And it's added already. It will add $1 billion to our general fund expenses in 2009-10, another $1 billion in debt. And I don't think people are aware of how much we are spending to finance the state. And just by what happened last year. So if we add $1 billion this year and we're adding, that's taking away from goods and services, and it's going to increase to maybe comprising 10 to maybe 12% of our budget will be to manage debt and pay debt. So I'm very concerned with that, and I think we need to look at how we allocate the funds that we are getting now. If we can't reduce them, which I think would add a stimulus in the way of, a or a dynamic economic model, I think we could use some stimulus that way. But even if we can't get agreement on the floor to do that, if we could figure out a way to allocate those peaks such that we can bail ourselves out, would be wise. Thank you.
All right, Mr. Taylor, thank you very much for your patience, for your graciously allowing Mr. Keeley, I'm going back to a law professor, to finish his testimony, and thank you very much.
Thank you, Mr. Chairman.
I'm going to ask, there's a witness that's got a plane to catch, Mr. Feely, and Mr. Keeley. So I'm going to ask that gentleman to come up, is it Ufret? Yes. And testify. He's the tax manager for National Steel and Shipping Company.
And then we'll have FTV.
Mr. Ufret, welcome to the Tax Committee.
Well, thank you very much for the opportunity to speak here. I'll try to make this brief. I realize we're a little behind schedule. And I do have, I apologize, Mark was going to hand out some things here that we've made available. We can hopefully do that afterwards then. First, just by brief background, as mentioned, I'm tax manager, General Dynamics National Steel and Shipbuilding Company, also referred to as NASCO. I've been an employee there for 30 years. Prior to that, I was in public accounting. I'm a CPA. I have a master's degree in business as well as a degree in economics from a University of California campus. And I did, in terms of the commission here, I did have the opportunity to attend the first commission hearing. I also got the opportunity to testify at UCLA at one of the panel workshops about the business net receipts tax. And so I'm coming in with at least some background there. But primarily, I think of myself as an economist to some degree, but really in my work, I'm a kind of a nuts and bolts accountant. So I'm kind of on the front line with regard to filing tax returns, and then I get involved and I see how the business reacts. NASCO is located in San Diego. We're the only remaining full-service shipyard on the west coast of the United States capable of building U.S. Navy ships. We also design and build all commercial vessel types, and we're the prime contractor and a strategic partner with the U.S. Navy for repair of multiple ship classes. We consistently deliver vessels to our customers that are superb in fit and finish and ahead of schedule and below budget. Just general background here. But we do face a very near-term significant business challenge. Our order book has currently no commercial work after the year 2010 and no U.S. Navy work after the year 2012. So in order to attract new business in the immediate future, it's very important for us to try to remain as competitive as possible. NASCO is the largest manufacturing employer in the San Diego region. We employ about 4,500 people, virtually all in the San Diego area, plus an additional 1,000 long-term subcontractors. We provide a critical employment niche between San Diego's high-tech industries and the service-based tourist industry, which offers much lower industries, the tourist industry does. We do provide above-average hourly wages with benefits to skilled tradesmen and women, along with extensive training and educational background. We have a very diverse workforce, lots of different backgrounds. We have many of our employees, in fact, I believe the majority are represented by the Boilermakers and the Machinist Union. So lots of union employee, lots of union jobs that we're involved with here. We rely on a stable, well-trained local workforce to meet the needs of our customers. And we do provide significant economic benefits to the state of California. In 2008, we spent over $500 million in payroll for employees and over 370 suppliers, generating approximately $1.25 billion in revenue for the California economy. In addition, we spent an additional $80 million on facilities relating to a new blast and paint facility that was an environmental significant improvement. Today I want to give just a little bit kind of real-world indication of issues with regard specifically to the business net receipts tax structure and what it could mean in more general terms to manufacturers in California, as well as using NASCO as an example for 3 primary points. First, obviously concerned about job creation, incentives versus disincentives. Second, competitiveness in the national marketplace. And third, the issue which has been mentioned previously with net operating loss carryforwards, which in my view encourage business risk-taking. It's worth noting that the deduction that is permitted under the BNRT for payments to subcontractors and suppliers, it reduces the tax, but there is no similar deduction for labor costs. Therefore, since labor costs are included in the net amount that is taxed, it appears to discourage needed job creation in California. Manufacturing jobs have a higher economic multiplier effect. We estimate it at 2.5 than most service jobs. Manufacturing companies are heavily dependent on the retention of skilled employees. The BNRT discourages just this type of job creation and has the unintended consequence of providing an incentive for manufacturing companies to relocate jobs elsewhere, in our view. Further, since manufacturing businesses regularly contract with subcontractors or suppliers that operate nationally or globally, again, the BNRT appears to unintentionally encourage sourcing jobs outside of California, a case of unintended consequences, I'm sure. Second, based upon the September 29th proposal, my preliminary estimates strongly suggest that NASCA would pay significantly more tax, and that's not surprising. I mean, this is a tax on business, but it's huge. In rough order of magnitude, maybe 4 times compared to the corporate tax, and so that all by itself can be very adverse to our particular competitiveness and market situation. We do compete, as I mentioned earlier, in a national marketplace. So there is a concern that if we are not competitive here, the jobs could end up elsewhere. The price of an ocean-going ship, such as we build, is determined, again, either globally or at a minimum nationally. And in order to protect the competitiveness of companies that employ thousands of people, such as ours, this type of major tax policy shift must be viewed in this international or national context. NASCO is already subject to a higher tax rate than our Gulf and East Coast competitors, and a shift such as the one proposed could make NASCO very much less competitive, resulting in business conditions that could lead to job reductions. Finally, shipbuilding does have a history of cyclical business periods, and losses have occurred in quite a few years. We're very volatile. We have our own volatility issue. The current tax system is helpful in a loss year because the net operating loss can be carried forward to offset taxes in a future or in currently past, now profitable year, sustaining and hopefully growing the business. The tax convention has the effect of encouraging business risk-taking, thereby creating jobs, with the state benefiting in the long run from the taxes paid in the sustainable years. The BNRT, again, has the unintended consequence of penalizing business risk-taking by levying a tax regardless of whether the company has any profits from which to pay the tax. So to recap some of my key issues and concerns, I'm concerned the BNRT is fundamentally a tax on jobs because when you do the math, labor is by far the largest cost component that is subject to the tax. The proposal would reduce marginal personal income taxes to rates from highest maybe 10.55% current law to 6.5%. that will indirectly significantly raise taxes and related costs on goods and services to lower and middle-income California residents. And from the company perspective, it would impose a higher tax on our employees and make it even more difficult potentially for us to recruit trained shipbuilders into the San Diego area. The lower profit margins that businesses that currently pay a modest corporate income tax, such as ours, our shipbuilding government contractor, we're not a high profit industry at all, but businesses such as ours would see a huge tax increase. This would exacerbate the already negative environment that California is perceived to face by some businesses. This, in turn, is likely to be adverse to the long-term fiscal health of the state of California overall, in my view. It would clearly have a negative effect on many of our suppliers. We do work with quite a few small businesses, and so the suppliers' health issue in terms of their business is a big deal for us. There are complex transition issues with regard to existing credits and NOLs and other tax attributes that are either ignored or, in my view, not dealt with fairly in this proposal. For example, under current law, credits such as the R&D credit that were awarded to companies for actions in accordance with state policy may currently offset in 2009 up to 50% of corporate income tax. Under the BNRT, the existing credits could only offset at most, as proposed, up to 5% of the tax spread out over a 20-year period. So that's a huge change in the rules. Again, the BNRT, I mentioned the NOL for a startup company, encourages outsourcing jobs to subcontractors or consultants. Another significant point, the authors are presuming the tax will be levied against companies in other states or countries that provide goods or services to California residents or businesses. And the tax would be apportioned based on sales in California. However, as I think you'll hear from others and have already heard to some degree, there are numerous legal issues with regard to nexus that are uncertain in this regard. A legal challenge from the perspective of the U.S. Constitution Commerce Clause is also worth noting. It's essentially a fair trade issue, and this is a concern. The proposed tax rate of around 4% for the California BNRT when it's fully implemented is much higher than a somewhat similar tax that's been recently implemented in Michigan. The Michigan rate is less than 1%, just as a contrast. And the Michigan tax, we've been told at one of the hearings that I did get to listen to at the commission, was too new to where they couldn't really identify the economic impact of that. But the proposed California BNRT rate is high enough that the BNRT could easily become a key factor in forcing marginally profitable businesses to either close their doors or relocate to another jurisdiction. So you have to remember this is taxed essentially on your total payroll is the bottom line what you're talking about. So when there can be a confusion thinking about the 8.84 corporate income tax rate, which is on profits, which you only pay if you have profits from which to be able to afford the tax, whereas this is fundamentally a tax on labor, which can be a much, much larger base upon which the tax is being levied. And in terms of the analysis that's been done, I wanted to mention, and I think it was mentioned previously somewhat, I know Commissioner Chair Parsky mentioned that they were only able to do the static modeling, and I think that's inappropriate for something of this magnitude. I think it's very important that a dynamic modeling analysis be performed so that you could properly, or at least have a better assessment of the likely consequences to the overall state of the economy in California. This proposal is essentially, in my view, an economics experiment with unknown consequences, and the risks, I think, are just too high prior to some additional studies being put into place. And I wanted to switch gears here just for a minute and talk about something that I haven't heard anybody talk about today. One of the Commission's proposals relates to a tax court proposal. This, and in my view, this would make this. The concept is this is in Appendix D of the September 29, 2009 Commission report. They're proposing a new independent tax forum to resolve tax disputes between the taxpayer and the state. In my view, this has not been adequately researched and is not as really of questionable or debatable value. The current process is the elected members of the Board of Equalization provide a forum that appears, in my experience, to work pretty well. The current system provides taxpayers with a venue to appeal tax matters at a cost that is much lower than would be the case in a more formal tax court system. And this arises because of the fact that in a more formal system you have rules of evidence and discovery, and you end up needing to have an attorney, whereas in the current Board of Equalization approach, I can, if I choose, represent myself and we don't have to incur a cost of outside counsel. From the shipyard perspective, we think the current California dispute resolution system is actually perceived positively compared to what we're aware of in other states. So I think there was an underlying premise that it was perceived negatively by the business community, but I would say that's not our view, at least. And others I've spoken with, I think, are in a similar posture to me in that regard. We've successfully had sales tax as well as corporate income tax issues that we have taken up through that appeals route and found it can work very well. It's also worth noting that there are additional costs of setting up a new state tax court system, which in this era of budget challenges, I think is a very questionable use of state tax resources. Seem to be many higher budget priorities. Essentially, I view this as a case where the current system is not broken, so there is no fix that's needed. The success of the Board of Equalization, it stems in large part from the fact that it is an elected body, not an appointed one. So because they are elected, the members of the board do have the responsibility of acting in the people's interests. And I think there's a concern that there's a conflict of interest because, of course, the Board of Equalization oversees the sales tax and other functions that are similar there. But in fact, because they are elected and because they do, at least in my experience, and I think this is borne out by their opinions over many years, they do take their charter very seriously, and they act independently of the staff that are administering or auditing the tax from the inside corporate perspective. In conclusion, I would respectfully encourage the panel to reject a plan that relies on the BNRT as the tax standard in California. The BNRT will serve to negatively impact industrial manufacturing growth in the state and discourage the creation of middle-class jobs and prolong the economic downturn. Representing just one of the manufacturers that would be harmed, the BNRT would encourage outsourcing jobs out of California, limit competitiveness in the global marketplace, and eliminate the net operating class carry forward to the detriment of business risk-taking. And I wanted to say NASCO is committed to growth and maintaining our position as an economic engine in the San Diego region. We're not a real portable business, candidly. We're the shipyard to build very large ships. We don't move easily. Nonetheless, we can be harmed and we could lose jobs to our competitors that are elsewhere. And I would also like to echo the thoughts of thanking the Commission. I think they had an extremely difficult task, a somewhat thankless job in the sense that any time you're talking about change in tax, it's difficult and it's awkward, very complex. They had a short amount of time, probably not enough resources or time to do what I think might have been the most valuable job, but still they should be commended for volunteering their time and taking the task very seriously and putting forth a good effort.
All right, thank you, Mr. Ufrit. Any questions? Okay, Ms. Harkey.
Isn't the tax replacement of the tax court with a commission? Can't the state also file an appeal in that case, if they do, as well as the business or entity that is disputing the tax?
I believe that's right. I'm not up on that aspect of it
that was
necessarily.
one part that concerned me, is that the state can in fact also file an appeal if they don't like the rulings. That was something that I thought that I read in somewhere. I'm getting a
right.
no here, but Not sure.
Yeah,
I'll ask you
I'm
later.
not one to say that definitively. Yeah.
Through the chair, Ms. Harkey, in the event that a taxpayer receives an adverse ruling at the Board of Equalization, they may appeal it to the Superior Court. If the state receives or the Board of Equalization holds for the taxpayer, the state does not have the ability to appeal.
But this new commission.
The new commission, the way that I read it, the
I'm sorry.
state would have the ability to appeal, so that would be a significant change.
Right, that's how I read the new, what's proposed in here that would be different from what we currently have.
Correct.
Okay, thank you.
All right. Thank you, Mr. Ufert. Would you please hand a copy of your testimony over to the sergeant? We'll make sure that it gets inputted as part of the permanent record. I'm going to ask, I'm really running late, so I'm going to try and get out of here no later than 5, I'll say 5:15, but I'm shooting for 5. So I want to invite FTB and BOE, although their testimony is separate from each other. Why don't we get everybody up here and then we can just listen to the testimony and ask questions accordingly. Just so we know, we'll have FTB sit in the front and BOE sit over here on the side. Looks like that's what I was working out anyway. I don't know if you have prepared testimony or if you're here simply to answer questions. But at least let me acknowledge you. We have Jay from... oh, yes. Now, we're going to get an you're going to give us an overview on the business net receipt tax, or is that just our title?
On both the business net receipt tax and the pit tax change.
Okay. So, Mr. Jay Chamberlain, Director, Economics and Statistical Research Bureau, Franchise Tax Board. Carl Joseph, Assistant Chief Counsel, Multi-State Tax Bureau, Franchise Tax Board. And Patrick, is it Kuziak? Kuziak. Forgive me, Assistant Chief Counsel, Technical Resources Bureau, Franchise Tax Board. For BOE, we have Brad Heller, the Tax Counsel for Board of Equalization, Jeff McGuire, Chief Tax Policy, Sales and Use Tax Department, Board of Equalization, and Margaret Shield, Assistant Chief Counsel, Board of Equalization. Let me, BOE witnesses, just bear with me, and let me start with FTB. I believe if you have prepared testimony, we want to hear it. I'm interested in two particular issues. The first one is your revenue projections on this proposal for that 5-year phase-in period, I think. And then also, I'd like to talk about the nexus issue, the economic presence issue.
Okay.
All right. And how the proposal will affect families. This new proposal would affect families as a class.
Okay.
All right. Gentlemen, what's your pleasure?
Okay. Well, thank you. I will go ahead, Mr. Chairman. First of all, I've presented some tables that you should have in front of you. I will try to go through them quickly. What they contain are our estimates. We were asked to analyze the Commission's package of proposals, particularly as it relates to the change in the PIT law, the elimination of the corporate tax, and the adoption of the net business receipts tax. And so I've given you those tables. Before we get into I would like to offer some caveats. First of all, as I mentioned, I am only looking at those three provisions in the three parts of the Commission's package. The Board of Equalization is looking at the sales tax. Also, we have just completed these estimates, so we're going to be obviously looking at these at these proposals, particularly the net business receipts tax over the next few weeks. It's possible there will be some changes, but I think broadly these numbers are correct. Second, just so you understand, we've done our estimates at 2007 income levels. Obviously, we're in the middle of a recession now. It's not clear what the trajectory of the recovery will take. So we have opted to do it at 2007 levels to ignore the impacts of the changes in the economy, sort of a full employment revenue estimate. Along those lines, we've also, as you mentioned, we estimated the business net receipts tax and the PIT tax change have a lot of transitionary issues. So we've estimated them 5 years into for what the law would be 5 years into the future. So we basically said if this had been in effect for 5 years, if it had been fully phased in, what would the revenue impact be?
Fully phased, so if it's fully phased, not this phase-in period over the next 5 years.
Right. We're just at the end of the 5 years, what would it look like in that year? Similarly, for current law, there's been a lot of tax law changes adopted since last September in the 3 budget deals. We've assumed all those are fully phased in as well. For instance, the elective single sales factor, the NOL carryback, all those provisions are assumed to be embedded in current law when we're making our comparison. Okay.
Do these estimates take into account the NOL or the single sales?
Yes.
Everything?
Everything, yeah.
Deduction, all of the exceptions are taken into account?
Right. Everything as they would look 2012 and beyond. Fourth, the language in the Commission's report left some blanks, so we had to make assumptions. For instance, the tax rate on net business receipts, I think that was already mentioned today a couple times. That was left blank. We've assumed the maximum 4%. And there have been a couple places where we had to make assumptions as to what would be applied. Obviously, if a different rate is chosen, the numbers will change. Okay. And finally, we have not made any. We've not attempted to make any adjustments for behavioral changes, and particularly in the transitionary period, we expect that there will be some behavioral changes. We've basically ignored those for purposes of doing our estimates. Clearly.
Okay, Ms. Vaughn has a question.
No, in terms of behavioral changes, there is a attachment to the General Dynamics. And I'm just wondering, when you talk about subcontracting out employees, how do you account for that?
Well, that's taken into account in terms of your projection, BNRT, or no?
No, it's not.
No, it's not. We have not assumed any behavioral changes. So
well, then you're also assuming the physical economic presence doctrine has been adopted by the courts?
Yes.
All right.
Yeah.
Okay.
We can go on, but I'm just saying.
We're going to have other witnesses tomorrow and on Wednesday, but tomorrow they can testify on. Actually, there's witnesses coming up after this group that can talk about the issues with respect to independent contractors and the revenue loss to the state. Okay, Mr. Chamberlain, please proceed.
Okay, thank you. Okay, so with those caveats, let's look at the numbers that the tables that I've prepared for you. The first table looks at our estimate of what the net business receipts tax would bring in at 2007 income levels. We compare it with the current law corporation tax, which includes the LLC fee, which would be repealed along with the minimum tax. Under current law, we expect that in 2007, with all the laws that would be in effect in 2012, fully phased in, the corporation tax would have brought in about $8.1 billion. The net business receipts tax is going to be levied on all entity types, and we're estimating that we were going to get $26.6 billion out of corporations, $8.1 billion from limited liability companies, $5.6 billion from partnerships, and $2.6 billion from sole proprietorships, for a total of $42.9 So just looking at those two components, the repeal of the corporation tax and the imposition of a business net receipts tax, we find a net gain of $34.8 billion. Okay, and that's all we have for the business net receipts tax.
Right. Well, I think we should point out, I think Mr. Parsky testified that over the 5-year period, with the phase-in, that the revenue estimate was that California would have $65 billion. Is that, I think...
I believe I heard him say that.
I believe he said that. One would guess that on the 5th year,
Oh, yeah.
well, so what I'm trying to do is extrapolate from what the $65 billion number, but you're saying in year 5, everything implemented, the revenue would be $42 billion.
Right, right. But now mine is done at 2007, and I believe that Mr. Parsky mentioned that theirs was, they had extrapolated out to 2016 or 17. So there is obviously growth in the economy during that period. I don't know if that would account for all the difference. I doubt that all the difference would be accounted for by growth. But clearly there's in some sense you're comparing apples and oranges.
Right. Okay, please proceed.
Okay. Next, I want to look at the change in the PIT taxes. And another caveat to add here is that when you're looking at the distributional impact of a tax, you need to look at the entire tax structure. We're focusing just on PIT, so to the extent that the net business receipts tax would have an impact on on individuals, that would need to be factored in as well. But just looking at the PIT by itself, we see that under current law, we received about $52 billion at 2007 levels. If the Commission's PIT proposal had been in place at that time and fully phased in, we would bring in just under $40 billion. So that's a revenue loss of about $12.5 billion. The other thing I should point out about this table in the next few tables is that we break down taxpayers by quintile so that you can we array taxpayers from lowest income to highest income, and we take the bottom 20%, the next 20%, et cetera, so you can get an idea of how the changes play out. Clearly, if you look at this, and I should say we also highlight the top 10% and top 1% of taxpayers. Clearly, most of the tax benefit is going to the high income. They pay most of the tax in the current law. They're going to pay the most under the proposed law. The top quintile pays, the top quintile is going to have a $11 billion drop in taxes, which is almost all of that out of the 12, but they're paying most of the tax to begin with. And I'll talk a little bit more about the distribution later on. So let's move to the next page.
You know what, I'm trying to multitask this here.
Okay.
Obviously not too well. Can we go over that again? This is the chart, page 3.
Page 3, right?
And you're saying the top...
I'm sorry, page 2.
Okay.
Yeah.
Okay, so you take me through that again.
Okay, so we've arrayed the taxpayers from lowest income to highest income. And then we took the bottom 20%, and that's the first quintile. Those are the taxpayers who have income between $0 and $13,790. Okay, and then we have all the other quintiles. And the purpose for doing this is you can see how the tax law changes play out over the different quintiles, how it affects the lower income taxpayers and the higher income taxpayers. And we also highlight the top 10% and the top 1%. So, for instance, if you look at the fifth quintile, which is the top income taxpayers, those making over $84,810, they're going to receive a tax reduction of $11.25 billion. The total, and if you look down a little bit, the total savings, PIT savings is $12.5 billion. So clearly, most of that benefit is going to go to the top quintile. Right, 84,000 above, right. Okay, and then move on to the next page. This highlights what was pointed out earlier. I don't remember the witness, but there was talk about, even though every income class is made better off, as you can tell, there are winners and losers in each class. And I'm sorry, there are people with tax increases there, and there are people with tax decreases in each income class. And that's what this next table shows, is that while every class does have a tax, and as a whole has a tax decrease, you can see that that there are individuals with tax increases in each income class. In particular, we've got we expect to have 7 million taxpayers that will benefit, and 3 million that will have tax increases.
Tax increases. You're saying 7. Run that by me again, please.
There's going to be if you look at the bottom line for totals, we have 7 million taxpayers that will have tax decreases, and then we have 3 million taxpayers that will have tax increases, going from current law to the Commission's proposal.
And you break that down by?
Again, by the same quintile and by the top 10 and top 1%.
So, 27 to 46. All right, all these tax brackets will have tax increases.
We'll have individuals that have tax increases. And
How are you getting to the totals at the bottom? Are you adding them up? The whole row?
how do you, I'm sorry, how do you?
Yeah, how do you, let's say tax current law column, that 52 billion? Are you adding up all the numbers on that row?
I'm sorry, what?
The total?
Are you on page 3? Or?
The totals at the bottom, are you adding up the whole?
Okay, on page 2, yeah. What you add for a column, you add up all the quintiles. So you just add up the first quintile through the fifth quintile, the top 10 and top 1%.
Okay, and the top 10% and 1%
they're part of the fifth quintile.
Okay.
Yeah, so those numbers are included.
You should have put like a line or something.
Yeah.
Okay.
Thank you. Okay. Okay, so we should move on from page 3. Okay, move on to page 4. This is further highlighting that you've got people with tax increases and tax decreases. Page 4 shows that you've got people who both people who are under current law are non-taxable but will be made taxable under this proposal. And likewise, you have many taxpayers who are taxable under current law who are made non-taxable under this proposal. Okay, and then the next table looks at the distribution of who pays taxes under current law and under proposed law. The first line just shows, and this again looks at the top 1%, the top 10%, and then each of the quintiles. The top line just shows how much income goes to each of those income classes. So, for instance, you see that the top 1%, they have 25% of income. And the top quintile has 65% of income. As I think Mr. Parsky had mentioned earlier today, even with the significant drop in taxes, the distribution of the tax burden pretty much stays the same from current law to the proposal. For instance, the top 1% pay 48% of taxes. Under current law, under the proposal, they'd pay 46.6%. The top quintiles paying 89% of PIT taxes currently. Under the proposal, it would be 89.1%.
Well, that's understandable. You didn't change the progressivity. You just gave a bigger tax advantage to the income.
Yeah. They're still paying most of the tax, right? Okay, and all I've got left now is some hypothetical examples, whose tax would go up, whose tax would go down. We put together 6 examples. These are all taxpayers who have the median income at 2007 levels. The first example is a single filer who has income of $23,000, no dependents, no itemized deductions, and no special credits. Their current law tax is $293. Under the proposal, their tax would drop to $109, so they would get a 63% drop. The second example is for a joint filer making $69,000, which is the median income for joint filers in 2007, with 0 dependents, $15,000 of itemized deductions, no special credits. Under current law, they would pay $12,046, or $1,246. Under the proposal, that would drop to $851, so they would get a tax decrease. The next taxpayer the next example is a joint taxpayer, again making $69,000 with 2 dependents, and they have $15,000 of itemized deductions and no special credits. This taxpayer would pay $658 under current law. Under proposed law, they would pay $851. Their tax goes up. The main difference there is that with the 2 dependents, they would be losing the dependent exemption credit.
Okay. So their taxes go up in these 2 examples by 31% and 29% respectively?
Well,
29 and then 437%.
The next example is the same. Think of that same family, except now they have some child care expenses that they're taking the child care credit for. If they lose that, they would lose that credit under this proposal. So their taxes would go from $158 to $851, an increase of 437%. So there's obviously quite overall taxes go down, but for individuals, the impacts are going to be. So
families with children are going to pay more in taxes.
Yeah, that's
on these assumptions, assuming that they meet these assumptions. But generally speaking, working parents that have a child care deduction will not be able to have it. And even if they have $15,000 in deductions now on their returns without the child care deduction, their taxes will go up.
That's right.
Significantly. Am I reading that right?
In this particular example, with different incomes, it may not be quite as significant, but generally, yeah, if you're losing that credit, it could be a significant increase. And the next example simply takes a single taxpayer who has a renter's credit, and we show that for that taxpayer, there would also be, well, there would be a tax decrease, but it would be less than the individual in the first example who did not have the renter's credit. So, I mean, what we're highlighting is that there's going to be a differential impact because this proposal gets rid of the credits, and because it limits itemized deductions, and because it gets rid of the dependent exemption credits. There's going to be impact on those people who are benefiting the most right now from those provisions.
Yes. Okay, questions? Oh, yeah. What is the overall net gain in revenue for the period of time you've studied with this proposal versus the current tax?
Okay, and I'm ignoring the sales tax. So just looking at the elimination of the corporate income tax, adoption of the BNRT, that's a $34.8 billion increase. And then if you, with the PIT tax changes, that's a $12.5 billion decrease. So it's about a $22.2 billion revenue increase for these provisions.
All right. Now, what can we expect? Does BOE done analysis? I don't think we asked you, but if you include the sales tax and use tax repeal, What are you have revenue projections, BOE?
Good afternoon, Mr. Chair and members. Robert Ingenito with the BOE's Research and Statistics Department. We actually modeled the sales and use tax proposal by the Commission along the same methodological parameters as FTB did, and we get a a revenue loss of about $25 billion based on 2007 data.
So 42 minus 25 is your net?
No, it's a,
Oh, yeah, 25, okay, 25
20
minus
22 minus 20.
Right.
22 minus 20.
That's correct.
So 2.8 billion loss. Well, comparatively speaking. Is that right?
Yes.
Okay.
Yes.
Right.
So it's not enough to cover the review.
Okay, so well, I guess the obvious conclusion is that the change would not be enough to cover the existing revenue stream. So I guess it's not a revenue neutral; it's revenue loss. Okay. All right, questions? All right, thanks, FTB. I think. Oh, that's right. I want the economic presence argument.
Good afternoon. My name is Carl Joseph. I'm the Assistant Chief Counsel in the Multi-State Bureau. Nexus is an area that my group covers. I think I would start by saying that earlier this year, the legislature passed a series of changes to the corporate apportionment scheme that included going to an elective single sales factor, meaning that if you think of income that's going to be subject to tax as sort of a pie, our slice of that pie is now going to be determined at the election of the taxpayer just by its percentage of sales in California. As part of that change, you adopted some changes to the way we calculate the sales factor, which was designed to better match the market, since now, of course, the market would be the one thing we're cutting up that pie with. And at the same time, you also adopted a what has been termed an economic presence nexus standard into the law. And what that does is the law says that if you have over $500,000 worth of sales that are assignable to California under the new assignment rules that were also adopted by the legislature, then you are deemed to be doing business in the state and will be a taxpayer. This is a bit of a modern trend amongst the states. A lot of states east of the Mississippi do not use the unitary method of taxation that California uses. They just look at each individual taxpayer and have to determine whether they are in or not in the state. And there has been much litigation about whether or not an economic presence in a state is enough to deem that you have nexus under the Constitution to tax that entity. Now, since about 2003, there have been quite a few cases that have gone through the system in a lot of the East Coast states. Of those, at least 3 of them have gone to the highest courts in those states and have been subject to cert petition review at the Supreme Court. The Supreme Court has not taken any of them. All of the cases held in favor of economic presence being enough. So where are we now with this? Well, all those cases were income tax type cases, slight variations here and there, nothing quite like the BNRT.
Not interstate commerce connected, necessarily.
No, well, they all were. I'll give you an example. A classic example was West Virginia had a case against MBNA America Bank. They had card holders in the state, but MBNA had no physical presence in the state. Okay.
Credit cards in the state?
They had yes, people utilizing their credit cards and buying all sorts of stuff, but the company itself had no physical presence in the state. The state of West Virginia imposed the tax. The taxpayer said, no, the Supreme Court's case Quill versus North Dakota that says you have to have physical presence applies. We're not a taxpayer. The state argued, no, you're a taxpayer. You have an economic presence here. People are spending money using your cards. And this went up to the West Virginia Supreme Court, who held that Quill does not apply to an income tax case and that economic presence was enough. So most of the cases that have gone the distance are cases that either involve financial activity, like the MB&A case, or cases about intangible holding companies, where there is a trademark or something like that being used in the state and the entity receiving that income has no physical presence in the state. Those cases also have held that an economic presence is enough. Now, the Supreme Court Quill case dealt with sales and use tax, didn't deal with income tax, so it left the question open. The Supreme Court has not reviewed it, so I guess you can say that at this point the final shoe has not dropped on this. However, the cases at the state level have been, at least in the last 4 or 5 years, for the most part, consistent in saying that economic presence is enough. The BNRT adds a slightly different wrinkle in that the BNRT is not a classic income tax. The Quill case talked about sales taxes and said a sales tax, you have to have physical presence. So what's the BNRT? Is it a sales tax or is it more like an income tax? That too is an open question. The closest that I can come for you on that is there was a case that went to the Supreme Court involving Michigan's single business tax. This was the tax that came before the new Michigan tax. And that tax was a value-added tax of a sort. It wasn't a subtraction value-added tax. It was an addition value-added tax. But nonetheless, it was not an income tax. And when it was analyzed by the Supreme Court for constitutionality of the tax, not a nexus question, but constitutionality of the tax, they analyzed it just as they would analyze an income tax. Okay? That's the closest that I can tell you we can come in the existing case law to where the BNRT would be on that sort of spectrum as far as physical presence obviously required for sales and use tax, income tax, least court cases for the state saying clear, not necessary, and then this BNRT thing, which is somewhere in the middle. So it is an open question. Obviously, we are going to have that issue a bit with the fact that it's in our corporate law already. It's not quite as difficult for us because that is, in fact, an income tax, so we at least have some guidance from other states on it. Certainly, the base is quite a bit larger in the BNRT, and it could have more impact there than it would in our corporate code. But nonetheless, the Commission is effectively picking up pre-existing California law when they utilize that economic presence standard as part of their apportionment scheme, just as they picked up the single sales factor and the new rules for assigning sales. All of those are already in the law. They just carried them over to this new base, this new pie that we're cutting up. So a lot of the rules for dividing are the same as they would be under the corporate tax. They're just being applied in a slightly different context.
That's right. What is, so you're saying the value-added tax, the only value-added tax that has been close to this BNRT has been analyzed by the Supreme Court. It's analyzed it like that it was like an income tax.
Yes. Mm-hmm.
But it hasn't overruled Quill
or distinguished it. That's true.
Distinguish it.
That's true. And there's always the possibility, this is all Commerce Clause analysis, so there's always the possibility that Congress could step in and regulate this area and say, no, physical presence is required. There have been bills in Congress almost every year to do that. Obviously, there's been opposition by the states on that, quite heavy opposition because of the way commerce is done these days. If you're not a state that has a unitary method, for instance, it is very easy to tax plan your way out of a state by utilizing physical presence nexus. So the states fight this bill, but nonetheless, in the Commerce Clause, Congress can regulate. And so, the Quill decision, to a lot of commentators, was an invitation to Congress to get involved in determining what's the standard for nexus. And up to now, they have not passed any legislation.
What would be the basis? They'd almost have to overrule Quill if they're going to, unless they distinguish BNRT as being an income tax.
That's correct.
What's the? I can see the argument that it might be an income tax. What's the argument that it might be well, it's a value-added tax.
I think the argument would be that, in a way, what it is trying to do is it's trying to tax consumption. It's utilizing a sales system. It's replacing a sales tax, at least in part. Hey, you know, this is very similar to a consumption tax. Of course, in the aggregate, at least in my opinion, it misses a lot of the things that a sales tax has, in that it is a tax that is done on a unitary basis. It's not done on an transaction by transaction basis. It's not remitted at the time of sale. It's not part of the, you know, attached to the selling price or anything. It is possible that in the BNRT system you could have purchases that outweigh your gross receipts and pay no tax. That certainly can't happen in a sales tax context. It is a hybrid. It is not a pure income tax, but it does have deductions from gross receipts. It's not a sales tax, but it is based on value added. It's a little bit like Goldilocks. It's not too hot and not too cold. But there has not been a case on the nexus issue that has addressed this at the highest court in the land. It has not gone that far. I will say that the state courts have been quite clear about the higher courts of distinguishing Quill and saying the court did not apply Quill to an income tax. It's basically relegated to sales and use tax only. So it's still a bit of an open question.
Interesting. Okay, well then, I want to have a further discussion on this.
Sure.
Can you come back on Wednesday when we're going to have a lot of experts and
Oh, I'd be delighted.
academics, and we're going to be looking at a lot of these questions. That's a key issue. Without that doctrine, if you will, being accepted as constitutional, the whole plan falls. And this proposal is all predicated on that.
Well, I would say that the fact that they're adopting a unitary system, in the unitary method, if you have a series of corporations that are all tied by common control in a common bond such that they're doing one business, they will be in the base just as they are now if one member of the group is in fact nexus taxpayer in California. So it's not as bad of an issue for us as it would be if we were a separate filing state. But I will agree with you that there are definitely corporations that are outside the state entirely right now that could be pulled in under an economic presence
Well,
system.
what about internet servers?
Yes.
I mean that's an open question. I mean,
Clearly.
Okay. Well, if you could come back, I'd like
Yes,
to talk
absolutely.
to you. All right, gentlemen, thank you very, very much. I'm going to talk to BOE at this point. Really, thank you for your keen analysis, not only in terms of using real numbers to project income. Oh, I'm sorry. Ms. Ma, did you have a question?
Yeah, no, I just wanted them to take a look at this attachment from General Dynamics and let me know if their calculation is accurate. And they are calculating it almost like a income tax, so...
And also, we had a shipbuilder, in effect, testify. Is that okay? All right. All right. Okay, well, that would be interesting to find out if there are niche companies that might be impacted differently.
Certainly.
Okay, BOE, thank you for your patience. We'll go very quickly, and then we're going to call the last witnesses up and give them a chance to all testify, but at least put them up to the table so that they've moved at least that far. But you've already testified as to what your revenue projections are, but you also want to have a statement as it relates to the tax appeals.
Repeal of the state portion of the sales tax, and that means who's going to bear the administration of this local tax.
Okay. All right. The repeal of the state portion of the sales tax and the administration, and who's going to administer it.
Thank you. My name is Margaret Shedd, Assistant Chief Counsel with the State Board of Equalization. You've asked us basically to address two questions. How does the proposal modify the current sales and use tax law? This was covered this morning, so I'll be very brief. Beginning January 1, 2012, it repeals or eliminates, phases out the 5% general fund rate. Currently, the base statewide, state and local rate is 7.25. On top of that are the local jurisdictions such as BART, where there have been voter-approved rates. Those are between 0.1% to 2.5%. This would eliminate the 5, except on motor vehicle fuel. That includes gas, diesel, and other vehicular use fuels. This is to maintain the current funding for transportation. The remaining state and local and district tax rates would remain, and so beginning January 1 of 2006, the general fund rate would be phased out, so the taxable rate on all tangible personal property, with the exception of fuel, would be 2.25%. So, and then, of course, there would still be the district add-on taxes. And at this point, the second question.
So the fuel tax will be administered as it always has been administered, and applied as it always has been applied.
Well, there's 2 taxes on fuel. The excise tax on fuel, that's unchanged. And the sales tax on fuel would remain the same at 5%. That would go to the state general fund to pay transportation.
Okay.
And the second question that you asked us to address is how the proposal would impact the funding of Board of Equalization sales and use tax administrative functions. I'd like to turn that over to Jeff McGuire now.
Thank you. Yeah, some questions I know that we get is that if you lower the rate, does that mean the cost of the program or what you actually do to run the program changes? And really the answer to that is no, because the same exact things will be subject to sales tax. The same taxpayers will be subject to sales tax and use tax. And so the same things that we administer to do for the state and local, we would still do for both just the local governments and then the state just for the gasoline purpose. So we'd still have 850,000 taxpayers that we'd still have to administer. We'd still have to issue permits, close out permits. We'd still have to process returns. We'd have to do refunds, appeals. All the stuff would still be the same to administer, just be the rate would be substantially less on that. The rate, as far as, if just in a real quick, give you some numbers, is that currently the sales tax program is $365 million a year to run the program, and currently the state pays $237 million of that, and the locals pay some differing amounts depending on which part they are, whether it's the city and county or the special taxing jurisdictions. But just taking straight from where we are today, if everything else stayed the same and then the state portion was gone except for the gasoline, the state's portion would go down to about $28 million for the sales and use tax program. And for instance, the Bradley Burns, which is the local and city portion, would go from $66 million to $191 million to administer the program. The fiscal recovery fund portion would go from $12 to $42 million. And then the local taxing jurisdictions, if no additional ones were added, they would go from about $50 million to $104 million. So all the locals would end up paying a much larger share of the revenue. Their revenue wouldn't change. They would still be receiving the same revenue. It's just mean the state's portion would be gone, and so therefore the state would, their cost would go down, because the costing model is primarily, although it's much more complex than I'm making it sound, but it's primarily based on revenue and which part of the revenue that you're receiving. So most of the work that the BOE does, they would still have to do for the local governments. I think some questions that would come up is, since we're really mainly then doing the tax for the local governments, what kind of influence do they have over tax policy and the sales tax program? Because currently that is administered by the state, and the state changes the tax laws. The locals have some influence on that, but then it would be primarily their tax laws that you would have. As you would have a phase-out period, there could be behavioral changes by consumers waiting for the tax rate to go down the next notch before certain large item purchases occurred. So that could have an impact on retailers and when sales would occur, and maybe when businesses would buy large assets and things like that. So there could be some changes in behavior during the phase-out period as people are waiting for the rate to drop down, kind of like we had with the car taxes. You know, the rate was going to go up, the licensing, so the retailers all said, buy cars now before the rate goes up. Same thing with the sales tax.
Do you have a revenue projection based on some assumptions as to, and based on some experience to determine, or let me ask you this, in computing the revenue, did you take that into account, that issue, when you computed
We computed the revenue loss was just based on static, what the current rate is and what we receive for the state portion, and the $25 million that we mentioned, that was just a static number, that not as a change in behavior. But the state would definitely lose its portion. Once it goes away, it's gone. So that's
All right, questions? I want to thank you very much for your patience.
Thank you.
You know, I went way over, and I'll just have to do better next time. But thank you very much.
Thank you.
Also, can you let us have a copy of your revenue estimates? Do you have some document? All right, let's call our last witnesses up. Kyla Christofferson, Policy Advocate, California Chamber of Commerce. Lenny Goldberg, Executive Director, California Tax Reform Association. Martin Martinez, Policy Director, California Pan-Ethnic Health Network. And Gene Ross, Executive Director, California Budget Project. My deep apologies for making you wait. I'm looking for, if you so desire, looking for another place to on the agenda either tomorrow or even Wednesday of next week, if that makes any sense to you. But I certainly want each of you to make your statement and then answer any questions that we may have. Who go, Ms. Ross? Did I say that right?
Sure. Thank you. I'm Jean Ross. I'm the Executive Director of the California Budget Project, and thank you for the opportunity to speak. And I think at the outset, I would say there are so many questions and so little information about what the Commission's proposals would do. I've given a handout to the Sergeant. I think your hearing today is to help begin to clarify some of those questions, but I think it also drew attention to just how little we know and some very, very, very important factors. And I think prior witnesses have hit on what we see to be the three major problems with the Commission's proposals. First of all, that it would result in a tax system that would be likely to grow more slowly over time, and that this would lead to larger, not smaller budget gaps going forward. And I think this factor alone should disqualify the Commission's proposals from future consideration. I think certainly what we had all hoped to see come out of it, and I will acknowledge the tremendous amount of work that commissioners put into this product, but I don't think any of us wanted to see a proposal, a set of proposals that would widen our budget problems rather than narrow them. And I think that this simply, the differential growth rates stem from what taxes are being reduced, and particularly the very significant reduction in personal income taxes paid by the highest income Californians. And that's where so much of the growth in our tax system and in our economy and in the U.S. economy more broadly has occurred in recent decades. And so if you reduce your reliance on that, you're going to have a tax system that has much less robust growth. Of the state's major taxes, the second most robust in terms of growth rates has been the corporate income tax. And again, the elimination of that would result in a slower growth tax system over time. And I think Chairman Parsky this morning said, well, the BNRT is going to grow. Yes, I don't think anyone disputes the fact that it will grow over time. What's critical is the differential growth rate between that tax and the taxes that would be reduced or eliminated. Second of all, that the Commission's proposals would shift the cost of paying state services from high-income taxpayers to low- and middle-income taxpayers. And I think Mr. Chamberlain's testimony illustrated the fact that even within the personal income tax changes, which are the good news part of the proposals, I think, in terms of reducing taxes, a very large number of Californians, and particularly families with children, would end up paying significantly more, while the highest income Californians would pay significantly less.
I will pay more.
I think
know about that.
I'm not touching that one with a 10-foot pole.
It just occurred to me I would pay more. I'm thinking that I'm done, but I'm not. I just had a little one.
And I think that is a very real consideration. Renters who would lose the renter's tax credit would likely pay more. I think there are a number of categories of taxpayers that could end up paying more in income. Well, we know now from the FTB's analysis would pay more in income tax and then would pay more of the business net receipts tax. So I think that is a very significant policy change, and I don't think one that's in the best interest of California. And within that, I would say even the Commission's own analyses, which show that the lowest income taxpayers in California would pay more, I think there is that very large $6.8 billion figure of taxes that would be exported either out of state to out-of-state taxpayers or the federal government through higher deductions. And I listened with interest to Mr. Eibel's presentation this morning, and I will certainly read his paper when it's released. I have very, very serious questions, and I've talked to a number of policy experts and economists about this, and I am not convinced that they are fully taking into account the fact that a lot of the business net receipts tax, in fact, the Ernst & Young consultants to the Commission say that 71% of that, I believe 71% of that would be passed through to consumers in the form of higher prices. I am not convinced that the Commission staff proposal is taking into account the fact that when you pass that through to consumers, you're going to be increasing the gross receipts of businesses. So then when they deduct the tax, rather than a true offset, you're just sort of doing a journal entry that gets you higher and then subtracting it back down. And yes, it's a 70% pass-through, but again, I think those assumptions deserve very, very careful scrutiny and some independent analysis, because I'm not convinced that they're treating both sides of the equation in a parallel way.
Well, the Ernst & Young incident report just flat out says that consumers and labor will pick up 55% of the tax.
And again, I'm not sure if the modeling on the income tax side, in terms of is this a revenue neutral proposal or not, are taking into effect that if 20% of the new tax is passed through in the form of lower wages, that means less income taxes paid to the state in exchange. And again,
given FTB's projections as well as BOE's projection, it would appear to be a revenue loser.
My ballparking, and I tried to grow it out to 2014, which would be the first full year of implementation. I will admit this is a rough analysis, but I did try to take into account the impact of the recent reductions in corporate income tax. That I guesstimate that you're looking at needing to replace about $56 billion. And if you look at the Ernst & Young handout from the June 16th Commission hearing, you would need a net receipts tax rate of 6%, not 4%, to get there. That's a $20 billion gap in the budget. That's the entire corrections budget, the entire higher ed budget missing. If those numbers come out wrong. And certainly there's been a lot of talk today about the Ohio revenue numbers coming in a little bit low. That isn't a tax, admittedly, identical to this. It has some similarities. Texas also has a tax that has some similarities, is by no means identical. They came up about a third less in their revenues from their new tax as well. And so I would encourage you to look not only at what's happened in Ohio, but also to look at Texas in terms of whether or not the tax is performed in a way that it's expected to. And I am aware, and I'm going to say one last thing and then let you move on to the other witnesses. And I think it's important in all of these analyses to note that they assume that the Commission's assumption, and this goes to the last conversation with Mr. Joseph, they assume that California can impose this tax on businesses that don't have physical presence in California. If we cannot do that, A, we're putting California businesses at a very large competitive disadvantage, and B, we have a very, very large hole in our revenue system. And I would say one of the real difficulties in terms of the impact of how much revenue comes in under the new system versus the old system is that because of California's 2/3 vote requirement to raise a tax, if you don't hit that target right to begin with, you're stuck with a very large hole in the budget that could only be made up by a 2/3 vote of the legislature. You know, maybe you can craft a very tricky trigger type target to work, but I think those historically have been fairly problematic as well. I would sum up, and I think, and I say this with due respect to the tremendous amount of work that the staff and commissioners put into this proposal. I think that the Commission's product is flawed because their initial assumptions were flawed. I think there are two primary flaws. First of all is that we have to totally restructure our tax system to address the issue of volatility. I think you manage that on the spending side, not on the revenue side. I think this also, we have a budget crisis. We need some additional money. And I think the Commission decided that the only way to address volatility was to reduce the taxes on the highest income Californians. And I think there was an implicit understanding that there was no transparent way to propose that. They could not come to you and say, we're going to tax groceries to give tax breaks to millionaires. We're going to tax child care to give tax breaks to millionaires. I think there was an understanding we're going to tax dry cleaning or haircuts to give tax breaks to millionaires. And I think that's why they discarded much, much easier ways of broadening our sales tax base. And I think instead what you've got is a tax that nobody has in the world and nobody really understands, because we've never traveled to a country or traveled to a state that has this type of a tax. And I think there is, on some level, almost an attempt to confuse you. And I think that's very, very, and to confuse Californians and California taxpayers and voters. And I think that's very, very unfortunate.
Well, it does. I do tend to agree with Mr. Keeley that volatility is going to exist no matter what the tax is. But it is a novel approach to, on the one hand, just to reduce volatility, simply eliminate taxes and that are volatile. Of course, they have the business net receipts, which really applies whether business is doing well or not. And I know a lot of businesses are very upset about that. So, any question?
Other than it might be more valuable to hear them all before we probe.
All right, let's hear from business. Ms. Christopherson. Thank you for your patience. I very, very much appreciate it. But since most of you are a part of the usual suspects, I imposed on you, and I thank you for your graciousness.
Kyla Christopherson on behalf of the California Chamber of Commerce. We completely understand this is a lot of information to process today, and we thank you for the seriousness with which you're approaching this and the many hours that have been spent today and we anticipate will be spent in the future studying this. We very much do appreciate the efforts of the Commission in the difficult task that they had in evaluating our tax system. We very much support their recommendation that further rigorous examination be done of their final recommendations. We do applaud them on recommending that the rainy day fund be strengthened. We agree with Mr. Taylor, Ms. Ross, that volatility can be addressed primarily on the spending side. We also applaud the Commission for recognizing that the high personal and corporate income tax rates in California, as well as taxation on business inputs, does negatively impact our economy and our competitiveness. Nevertheless, we do have concerns about replacing current major tax revenue sources with an untested new tax, the business net receipts tax. And we think that without examining it closely and with substantial time devoted to that, it could have its own set of harmful consequences. We're going to be providing written comments in terms of a list of concerns we have, so I won't touch on all of those, and I'll just highlight a few. Number one, businesses, it's important for, we believe, the legislature to know that businesses are not going to be able to do a full analysis of the impact of the BNRT and related tax changes without having a precise rate that is specified. There's no rate specified in the Legislative Council language. There's no cap that's specified. There's been some discussion of a 4% cap. That's nowhere to be seen in the legislative language. Additionally, as part of the Commission recommendation, it appears that during the transition period, the rate is going to be unknown from year to year because it's supposed to be an annual determination, and it's important that that it be known that the business community is going to it's going to be impossible for them to determine the impact and also to manage that kind of uncertainty with a major tax rate. The other concern with uncertainty with the rate would be, would the 4% be satisfactory? What's going to happen to the 4% rate or whatever the ultimate rate is if the revenues don't come in as anticipated, and who will ultimately have the authority to set that rate? Moving on to an additional concern, we think that there's serious fairness and equity issues with the BNRT proposal, and fairness and equity was one of the factors that was to be considered by the Commission in addition to economic health and competitiveness. In particular, as has been mentioned by earlier witnesses today, companies in a loss position would still have to pay this tax. That could have serious ramifications for, we think, particular types of companies. For example, startup companies, they usually go for some time without earning any income, yet they would now be subject to taxation. Companies with low profit margins and high employees costs would be especially hard hit, we believe. In addition, the small business threshold is quite low for the exemption that's provided, and so we think that sole proprietors, pass-through entities could be especially hard hit. They would not benefit from elimination of the corporate tax because they pay the personal income tax. This would also amount to a net increase, we believe, on companies that are in the service industry. Many of them are small businesses as well. In terms of the impact on California jobs, we echo the concerns that were expressed by the individual from NASCO that this appears to be a tax on employees. There are no deductions provided for employee compensation, employee benefits. This would appear, we agree, to create an incentive to outsource to companies in other states and nations, as well as independent contractors who fit within the exemption, the small business exemption. We are not convinced that the nexus standard that is being relied upon to reach the out-of-state companies is reliable, and we do agree it could be subject to immediate legal challenge. We also question, while we agree that there could be a very serious consumer impact if the business net receipts tax is passed through to consumers, we're not convinced that so much can be passed through. In fact, we are concerned that companies will have to absorb a number of those costs because, for one thing, it's not like a transactions tax where you can itemize the pass-through and it's clear that the additional price on the good or service is attributable to the BNRT. And the other problem is that there is a competitiveness issue. Anytime you are having to compete in markets, then pricing can't necessarily go up super high, or else you're losing out on those sales. And so we think those are all very important. So To conclude, we thank you again for the time you're devoting to this. We would respectfully urge the legislature to devote substantial time to this, to not be subject to any arbitrary deadlines in terms of the time spent in the analysis. We would appreciate the opportunity to respond to an analysis that we hope would cover a long-term period of several economic cycles going backward and forward, a minimum of 10 years. And we would reiterate that the restoration of California jobs and the economy, we think, is a top priority that should be considered in this overall evaluation of our tax structure. Thank you.
Thank you. Mr. Martinez.
Thank you very much. I'll be really brief because Ms. Ross helped set up a context for me. Marty Martinez for the California Pan-Ethnic Health Network, and we're a health policy advocacy organization, so we've never testified before this committee before. But we became extremely interested when we heard about what we understood the Commission's proposals to be, and from our understanding of them, they are moving us away from the direction California needs to go to address health disparities and the health of low-income communities and communities of color. There's growing particularly the two issues are the inequality that the decrease in progressiveness of the tax structure would create, as well as what we believe appears to be the fact that there would be a net decrease in revenue. And while we appreciate the need for reducing volatility, from the concerns of our communities, we think the issue of inequality in the tax structure and revenue are much more significant. There's growing research that our life expectancy falls directly along the social gradient of how much wealth we possess, and that as the tax system and as it becomes less progressive, and as economic inequalities increase, health disparities increase as well. And we'd love to see, that this literature is still obviously too new to really factored into the analysis of the Commission, but I really think that that economists need to take this into account, how if we are going to have a less progressive tax system, how we are going to also then have additional healthcare costs. Just where we're based in the area of Oakland, people in West Oakland can expect to live 10 years less than people who live in the Berkeley Hills, just some miles away. There was some testimony earlier that potentially if low-income Californians are paying disproportionately more relative to their income, that could be compensated for by additional services that we could be getting. But this is where then we also get hit by the other hand of what we see in the Commission's proposals, where if total revenues are going to go down, programs that we rely on, like Medi-Cal and Healthy Families, have been consistently hit by each budget crisis and have been consistently cut. And so we're concerned that really, from what we see anyway, and we appreciate all the effort that went into the Commission work, but we are really concerned that from our perspective of the health of low-income Californians, we're really going to be hit then twice by increased inequality, which would lead to worsening health for our communities, and then also reduced revenue, which then we believe, and we've seen happen before, could result in additional cuts to the programs that we rely upon to try to pull us out of that health slump. So thank you very much.
Thank you. And last, certainly not least, Mr. Goldberg.
A usual suspect in front of this committee and at this table, although Ms. Harkey is usually sitting over there. I really appreciated the fact that this commission existed and put a lot of things on the table. I testified twice on split roll, actually. I felt like the issue was given some hearing and then no substantive work was done after that, and so I would appreciate continuing having those conversations. And I think my recommendation to this committee is to take this broad stroke proposals and say, what's wrong with our tax system and how are we going to solve it? Let me just start really quickly with the personal income tax, because that chart really, which was presented at the very first hearing of the Commission, and I want to recommend Phil Spielberg's presentation on the tax system from which this chart is taken. But when you look at this chart, and this gets to this whole question of volatility and personal income tax, the top 1% of the population had 14% of the income in 1993. If you go back to 1980, the top 1% had 8% of the income. And that's a reasonable number. They're the very, very rich people. They have 8% of their income. Well, by 93, they had 14% of the income. If you look at this chart, by the 2000, in the dot-com run-up, they had 28% of the income and now have 25. Think about that. The top 1% has 1/4 of all the income in this huge economy. It's a very small number of people. The top 10% have 50% of the income in the entire economy. So where does volatility come from? Wealthy incomes go up and down more often than 50.8% according to Mr. Chamberlain's chart, but 25% for the top 1%. Now, their income is going to be volatile. The reason we depend so much on the top 1% is because they have such a high percentage of the income. And the state of California is not going to redistribute income. Nobody knows how to do that, even if we wanted to do it. So what you have to do is look at what is the distribution of income? Why has volatility, if it has, I think there's some doubt about that, but why has volatility grown? One of the reasons it's grown is we've had two incredible bubbles recently, which are really about the underlying economy and not about the nature of our tax system. We had an incredible bubble running up to 2000. We thought, I have to say I was wrong. I said, that's a bubble we're not going to see for another, half a century. And then we saw another bubble 8 years later that actually brought the entire financial system crashing down. That's why we're volatile. That's why we're in such trouble. And that top 1% has such an unprecedented, let me say unprecedented, only in the 1920s has the top 1% had that percentage of the income. So my view is that, and I want to pick up on something that Mac Taylor said. He said you can take this as a variety of pieces. I would say take the income tax off the table entirely. That's $15 billion that you don't have to worry about. That, I think there was never an iota of evidence, and I looked at the beginning comments here about there's some issue about investment with regard to the wealthy. California has more of the Forbes 400 than 3 of the states. Texas, Florida, and Nevada have larger population and no income tax, and we have New York and California have most of the very, very wealthiest people in the country. There is no data whatsoever that show that wealthy people are leaving California. For many, many reasons. We pay $2 million more for a house here than in Texas, and you're going to stay here anyway. That's why you're paying that money. So there's nothing about the income tax that we need to address with regard to reducing it and flattening it. And let me say this other piece, which I think is mythical. The idea that it's going to be simpler, Mr. Parsky said you can put it on a postcard. We pay, virtually all of us are paying our state taxes completely based on our federal taxes. We take the deductions and we write them in. There's nothing, and now it's true, a $45,000 exemption will take a lot of people out of standard deduction or using itemized deductions. But if you're already doing that for the feds, what's simpler about it? So we see on the income tax side, we see no evidence that there's any economic benefit. In fact, I've argued for higher taxes on the wealthy, but that's not at stake here, that we should do anything on the income tax, and the simplification doesn't help the taxpayer who is already doing all this for the federal. Corporation tax, very briefly, we have made a mess of the corporation tax in particularly the last two of the last 3 budget deals, and I think the base is very, very weak, which is why we're using an $8 billion number instead of a $10 billion number. But the corporation tax exists in 47 states. If you look at the chart here, among the largest 10 states, our rate is not that high. It's also about total business tax burden. I don't believe there are any proof that anything has to do with marginal rates. But the one thing that the corporation tax does is that corporations are held by shareholders all over the world and all over the country. I would argue that because they're in a national and global environment, that it is the owners of capital, that is to say the shareholders, who pay that corporation tax. That means the corporation tax exports a significant amount of the tax load, and that's appropriate because they are benefiting from the use of California resources. That's sort of ground zero with regard to the corporation tax. We definitely want to keep those out-of-staters who are profiting from California and using California resources contributing to that. Now, I will not, Assemblywoman Ma, get into the single sales issue right now. Business net receipts tax. One of the things that I think there, and I've talked to NFIB and the Chamber and others. I think there is this is actually, we're not coming at the issue differently. There seems to be a realization that what we should tax is profits, and if you don't have them, you probably shouldn't pay them. And one of the problems, let me add to, that's a discussion others have had, the BNRT, you draw in all these lines. So I've looked at this because I know something about the rental housing industry. First of all, we're going to be taxing rental housing when homeowners, another discussion, have more tax benefits than you could possibly pile on any of us. We have fabulous tax benefits, and we're going to be instead, so we don't do anything there, but we're going to tax rental housing. Now, if you're a smaller landlord, you probably won't be taxed. If you're larger, you probably will be. I did a little numbers, and if you have 20 or 25 units, you're probably under the $500,000 threshold. If you have more than that, if you're a large owner of apartments, you're above it. Now, we have rent control in San Francisco, Oakland, San Jose, Los Angeles. Those will allow for the pass-through on all these renters of all this tax. Now, we know renters are half the income of homeowners. I mean, that may have changed in this foreclosure crisis, but generally they've been half the income of homeowners. Homeowners have fabulous tax benefits. This is a tax on rental housing and rental property. Now, when you start drawing all these lines, 500,000, well, we can get consultants who do under 500,000, or we can take an apartment unit that's owned by a number of partners and break it up and say each of us have got 20 units and we're all under the 500,000. As soon as you start drawing these, as we all know from the many bills that come here through here, as soon as you start drawing these arbitrary lines in tax policy, everybody with their accountants are trying to get on the other side of the line. And I think that both Kyla and Jean made comment about out of state. If the nexus issue doesn't work, everybody's going to be hiring consultants and services from out of state. Now, one issue that we addressed, electronic commerce, is every payer, everybody who's Overstock.com, selling into the state of California, claiming they don't have nexus, arguable question, but claiming that they don't have nexus, are they going to now be collecting on their, certainly not their gross receipts, they're going to have to do a net receipts calculation for the electronic commerce they say here. Digital downloads, I know an issue of great interest to the chair and to myself. Major part, 21st century economy. Fred Keeley said part of the 21st century economy, green economy, never addressed. Another part of the 21st century economy of anybody's definition is internet and electronic commerce. Now, maybe BNRT, if it's sort of broad enough, will get Overstock.com and all the people who are selling on the internet. If they have $500,000 of gross receipts in California, then they have to go back and apportion their income as it is through the audit issue. We didn't ask the FTB about the audit issue, but the audit issue for every internet seller in the state, in the country or the world that is selling into California, I would expect would be a major issue. Now, maybe there are answers for that, and maybe the result is we do get all the electronic commerce and every digital download that's coming along. I would have said a commission on the 21st century economy should explicitly examine the nexus issues, the digital the electronic commerce issues. There's a whole range of what we're doing that needs examination. Never examined. It's sort of hand-waving, leaving it to, oh, business net receipts is going to get everything. Well, I'll certainly believe that when I see it, but certainly, and maybe it'll be very small because if, as I said, we take the income tax off the table, maybe take the corporation tax off the table, then you could be talking about gross receipts on professionals, as cities do, at a low rate of 1% that pick up some of the services. There are some ways of having that discussion. I'm sorry I went on a little too long, other than to say I'd love it if this legislature gave a really full consideration of split roll. We're doing research now and finding tremendously robust data about this, so we'll be presenting that at some point.
All right, questions? No questions?
Mr. Chair?
Yes, Ms. Hart.
Mr. Goldberg, I can always count on you to hit Prop 13. I mean, that's kind of where I believe that you've always wanted to go. The problem that you have is, again, like I say, if you don't understand the way leases work and you start doing that split roll, you're going to find that's hitting small businesses, small companies. So I think to go after business income tax, or the big bad bogeyman business on the Prop 13 side might sound like a good idea, but I think you're going to find that it affects a lot of small companies, because the ones that I have checked with are very, very upset with that potential.
I totally appreciate that, Ms. Harkey. One of the things that I think is really wrong-headed about our tax system is in fact, on small business, the personal property tax. Every bit of equipment that you put in place, you pay sales tax on, and you pay personal property tax on, and if you're a restaurant and you're depreciating it over 10 years, you're paying almost the equivalent of another sales tax on your personal property. When we get there, there are lots of ways of mitigating the small business issue.
All right. Yeah, let me just say, and after making everyone wait, I have got to go. I have to leave, so I apologize for that. But I did want to thank the witnesses here at the table. I want to thank all the witnesses for being here. I want to thank everybody else for their patience and their interest in the bill. I'm going to turn the gavel over to Mr. Cotto. There's still a public comment section left, and tomorrow we will reconvene at 10 o'clock and take more testimony.
Thank you, Mr. Chair.
We're going to continue.
Okay.
This is the point at which we have allowed for some public testimony. Is there anyone in our audience who wishes to testify before this commission? Please come forward.
Mr. Chairman, members, Joshua Shaw with Shaw, Yoder, Antwi Legislative Advocacy today, representing the California Transit Association and a variety of our firms, local public transportation agencies and individual regional transportation planning agencies. Our concern is about the billions of dollars that flow through the state budget every year to these agencies that provide services on the street, the engine of the economy, moving people from place to place. You heard the chairman this morning say the commission report says the sales tax should go down and ultimately away, except for on gasoline. We want to emphasize that almost every cent of money that goes into public transit agency coffers from the state, at least until this year when you zeroed out the state transit assistance program for a while, but all of those dollars should be available for transit. They are all sales tax on fuel related, either the sales tax on gasoline or the sales tax on diesel, one way or another. We also want to emphasize that when you read the Commission's summary information, when it says sales tax on gas shall be exempted, there's a reference to Prop 42. A lot of you think of the sales tax on gas as Prop 42. That is good for streets and roads at the city and county level. That's good for the highway program through Caltrans. Some of that goes to transit, but there are other sales tax on fuel related revenues besides Prop 42 that have historically gone to public transit, and we cannot lose that. And the Commission doesn't specifically figure out how to start to refund transit, given the fact that the budgets the last couple of years have deleted transit funding. But a starting place is not eliminating the sales tax on any of those fuels, diesel or gasoline. Thanks for your consideration.
Thank you very, very much for your comment. Please.
Mr. Chairman and members, John Gamper representing the California Farm Bureau Federation. We are a $35 billion industry in the state. That's farm gate value that multiplies through local economies. We are price takers. We are not price setters, so there's little pass-through capability in our industry. We are labor intensive, and we use other people's money, and according to the Commission's report, you cannot deduct your interest payments from, and we're also land intensive, obviously. So while we have not plugged in the numbers for all of our agricultural operations, we can tell you that just by the very nature of what is essentially a gross receipts tax or a tax on labor, it's going to be problematic for agriculture, just based on those parameters. Now, also understanding that if you look at the agricultural economy of California and the number of farms and the number of food that those farms represent, it looks almost like the pit. I mean, we've got a very small number of producers that produce about 80% of the food, and about a very large number of farmers who produce about 10-15% of the food, and just the opposite, 15% produce about 80%. So we're going to have a vast number of small farms and ranches that will be exempt from the net receipts tax, but it's going to have a major impact on food producers that are going to be hit. And of course, like the shipbuilder, we cannot leave the state. We're here to enjoy the climate and the soils and the water. With that, I'll
Thank you.
quit. Thanks.
Thank you very, very much for this comment, and thank you for your patience. And members, that concludes the public testimony. Any comments by members of the board before we recess this meeting till 10 o'clock tomorrow morning? Hearing none, this meeting is now recessed till 10 a.m. By the way, thanks to all the staff. Wonderful job. Great. There's so much excellent material and so much information that was provided. So we'll see you all tomorrow morning at 10 a.m.